It's his flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures pulling back this morning after the S&P 500 closed at a new record high as investors digest everything from earnings to tariffs to jobless claims, which came in higher than investors expected. On the trade front, President Trump telling reporters it would be possible to reach a new deal with China, signaling he's open to preventing a trade war between the world's two biggest economies.
Plus, Walmart falling this morning. The retail giant's profit forecast coming in lower than expected for the full year, suggesting that the uncertain economic environment is hitting the world's largest retailer. The company expecting overall net sales growth of up to 4% for the year. That would be lower than last year's 5% growth.
And Palantir shares are under pressure as the Department of Defense plans to reduce military spending by 8% over the next 5 years. Analysts are mixed about the impact this could have on the software company's business. Meanwhile, the stock also falling on reports CEO Alex Karp has adopted a new stock trading plan. Well, U.S. stock futures are lower this morning. The downward pressure, though, context here, comes after the S&P 500 reached its second straight record high. Yesterday, we saw that, and ultimately, as we're continuing to look at some of the fractional declines here during the day, it still has been a sign of a persistent and resilient market, at least for the S&P 500, with these new record highs, despite and moving through some of the tariff talk that has certainly ramped up over the past week and change.
Yeah, Brad, what's interesting to me is very much the market once again kind of shrugging off any sort of development when it comes to tariffs. And I think that's very much just a reflection of a lot of that uncertainty coming out of Washington, kind of this whiplash that seems to be a headline-driven sort of mentality here over the last several weeks. So not necessarily a buy-in yet here from Wall Street, which I don't think comes as a big surprise. To me, also, the other thing that's standing out this morning is the weakening econ data that we are starting to get. When you take a look at jobless claims coming in above expectations, when you take a look at the Philly Fed survey, also offering some evidence there of slowing activity, and coupling that with some of the other weakish economic readings that we've gotten, and had inflation coming in hotter than expected just last week. Of course, that is becoming more of a focus here for investors going forward. The impact that is going to have, though, on the broader market, obviously, is still a big question, whether or not it is enough to halt some of the recent gains that we've seen.
Yeah, absolutely. As we're continuing to track some of the pressure this morning here, of course, it does come with the backdrop of some of the earnings as well that had come out this morning, which we're about to get to. But all of this amid an earnings season where the forecasts, as we've been discussing with some of our guests over the course of this week and the entirety of earnings season, they were looking for some of the earnings forecasts to be revised. We've got a lot of those revisions here, and I think that's exactly what investors are also trying to parse through here. How much of that pressure is on the front end of this year and the chop and volatility? Then once we get towards the back half of this year, is it an easier environment to navigate? UBS has been quite persistent with some of their calls, saying rise that they're anticipating. Even despite, I think their words were, even despite tariffs, they were still looking for gains. But that volatility is something that we've heard pretty much across institutional firms.
Yeah, and I think the question also is, where is that leadership going to come from if we do continue to see this momentum to the upside? Obviously, as you take a look at the performance, the year-to-date gains, big tech isn't as big of a driver as it has been over the last 2 years. Yes, Meta accounting for much of the gains here for the S&P 500, just in terms of relatively speaking. They are the top contributor to the S&P gains since the start of the year. But when you take a look at those top 10 contributors, and something we've been focusing on here at Yahoo Finance, it's much more than just tech. So I think you can take a look at that, take a look at the broadening, and take it either two ways. One, maybe that points to some opportunity outside the U.S., overseas. That has certainly been a theme that we've been talking about here at Yahoo Finance. But then two, obviously, this is something that we have been waiting for, something that John Stolfus over at Oppenheimer has talked to us time and time again, that is going to be enough to keep this momentum going in the U.S. market. So again, you do see Wall Street split just on the direction of where the market is headed next.
I didn't want to misquote UBS here. Growth despite tariffs was one of the themes that they had talked about. And to your theme of tech that you were mentioning, they had just mentioned yesterday, the theme of the decade was AI here. That is what's emerged from their chief investment office as the theme of the decade here. So we'll continue continue to track that and the trade here this morning. Switching gears, though, we talked about earnings. Walmart shares, they are on the move for ticker symbol WMT, lower, though, by about 4.7% pre-market after the company's full-year profit forecast fell short of analysts' expectations. The cautious guidance sparking concern that an uncertain economic outlook and tariff backdrop is impacting the historically resilient retailer. Joining us now to break down the latest print, we've got Yahoo Finance's Brooke DePalma. Brooke, I mean, you were just sitting there off camera, still listening into the earnings call.
The call just ended.
Okay, all right, so what did we hear?
Yeah, well, tariffs was a focus eventually in the call. It didn't come out right at first, but an analyst did ask about it. Now, we know that Walmart touts that about 2/3 of its products are made, grown, or assembled in the U.S., and so they have a bit of lower exposure compared to their retailer peers, but executives eventually did weigh in on it on the call. Take a listen.
Tariffs are something we've managed for many years, and we'll just continue to manage that. We've got a great team. We know how to do that. We can't predict what will happen in the future, but we can manage it really well. And we're wired to try and save people money. So that'll be our ultimate goal.
We don't have any explicit assumption in our guidance around tariffs. We feel like we'll be able to navigate that. Will it turn out differently than maybe what we expect today? Perhaps. And we feel good about our ability to do that, though.
Something interesting here is that global inventory is up 2.8%. The company did say that they pulled a bit forward around the edges, that they're selling through that stuff quickly, so they're in a good place to kick off February. But in the past, as we've heard from CFO John David Rainey, that cost, that brunt, might eventually have to trickle down to the consumer. And should that happen, should these tariffs go into effect, we also know that their private label business could potentially benefit as well.
Yeah, Brooke, one of the big issues and why we're seeing such a decline here in pre-market trading has a lot to do with the guidance and some of the concern that maybe this points to going ahead here for Walmart.
Yeah, that was one of my big top takeaways from the earnings results this morning, was that conservative 2026 guidance or fiscal year 2026 guidance that they had set out. And CFO John David Rainey saying on the call this morning that they're operating in a highly dynamic backdrop for several years, and they expect this year to be no different. Now, they do expect net sales to increase in the range of 3 to 4%. That would be lower than how they ended this recent fiscal year, but he calls it a relatively stable environment, or assuming that it will be that, and acknowledges that there are still uncertainties related to the consumer behavior and global economic and geopolitical conditions. Now, another top takeaway is this strength in the U.S. grocery business that we continue to see, as well as strength from their wholesale retailer, Sam's Club. We know that 60% of U.S. sales are that grocery business. We saw that business increase mid-single digits, as well as Sam's Club's, their membership model hit all-time high, their renewal rates rather. They also boosted up inventory there. And a last final top takeaway here is this ongoing trend that they continue to gain higher income shoppers. This has been going on for years from Walmart, especially post-COVID, as they really doubled down on this idea of making sure that they deliver that value, but also that convenience. We saw Walmart Plus membership income grow double digits during the quarter, and also they've been doubling down on that same day delivery. Ultimately, to compete with Amazon seems to be working here.
All right, Brooke, great stuff. Thanks so much. We are going to continue this conversation, take a look at some of the drop that we're seeing here in Walmart shares. If these losses do hold, we could be looking at the worst day for Walmart stock since November of 2023. We're going to discuss all of this with Oliver Chen. He's TD Cowen's senior research analyst. That's coming up right after the opening bell at 9:30 a.m. Eastern time. Well, stock futures set to pull back from record highs after this morning's jobless claims in the Philly Fed survey, adding to a string of some of that weakening econ data. And some market participants out on Wall Street are warning that the recent rally that we have seen, those record highs for the S&P, could actually be due for a pause. Let's talk about what's next. And for that, we want to bring in Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Victoria, it's great to have you back here on Yahoo Finance. So talk to me about where you see the market headed. How big of a risk are we at here for some of this momentum to come to a halt?
Yeah, Shauna, I think it makes a lot of sense that as we look at the expectations we have in this marketplace, look at earnings. I mean, you're just talking about Walmart earnings. People are expecting another full year of double-digit earnings growth. That's been very supportive of this market and the bull run that we have seen so far. But I do think when we look at the bifurcations that we're seeing, whether it's sectors within the S&P, whether it's triple Qs versus Bitcoin, whether it's S&P and Nasdaq, and how we're seeing relative highs hitting here versus not in the advanced decline line. Lots of bifurcation going on that we've talked about in the consumer, but we're seeing it really flow through to this market. So we wouldn't be surprised to see a 5 to 10% pullback. That doesn't put us into recession, but it does help the market come back and consolidate a little bit around some of these very lofty expectations that are out there. Although earnings have continued to do pretty well, we need to see them hold up in the next few quarters in order to sustain the valuations that we're seeing. And I think that might be a tough call to make.
Which sectors are best positioned from your analysis, even amid some of the bifurcation that's expected?
Yeah, so Brad, I mean, look, we like financials. We've talked about it many times. It's been our favorite sector for a while. And when you look at trend lines, when you look at momentum within the sectors, financials continues to do well. And it's actually had a little bit of a pullback, a little bit of consolidation, but still in an uptrend. So we like financials and think you can continue to add here. You've had a little bit of momentum in healthcare as well. We know that sector has been hit really hard, but perhaps you're starting to see an area where you could tiptoe in to that sector and add. But you're looking at parts of industrials, you're looking at staples, you're looking at utilities. These are really the bifurcated sectors where you have to go in and really do your homework on the fundamentals of the names that are in there and not just do a sector across the board. It really bodes well for active management. It really bodes well for long short portfolios for our clients.
So Victoria, I guess overall then, do you think that the resilience that we have seen in the market, is that justified?
I think it's justified to an extent, and there's probably a little bit more room to go here. We know 70% of our economy is driven by the consumer, and the consumer continues to spend. We've seen that in the consumption numbers. But Shauna, look, we saw numbers go up on consumption, but we saw savings numbers come down pretty significantly. We're seeing composite PMIs that are equivalent or correlate to about 1.5 to 2% GDP growth. That's slower than where we are now. So is there a little bit more room to run here? Yes, because earnings are still supportive. But are we seeing things telling us the economy is going to slow down? Yes, we are seeing that as well. So I think you do have to be cautious in where you put your money to work.
Do you think that that will mean sweeping earnings revisions, or will it be selective? What are some of the pillars that you would be looking out for there, especially as we're getting through some of the retail portions and the most consumer sensitive portions of this earnings season?
Right. I mean, you take Walmart as an example, since we saw those earnings today. I mean, that was the shining star for retail last quarter. And now they're even giving pretty conservative guidance for 2026 and talking about even some of the high income consumers starting to spend down and pay less. So I think when you're looking at earnings, I don't think we'll see a sweeping movement across. There's going to be sectors that continue to do well and have support. We talked about financials continuing to do well and other areas starting to come back a little bit. But obviously, you look at Mag 7 names, you look at some of the valuations that we're seeing there, those are starting to pull back. And we have to wonder if the earnings we've been seeing this quarter, Brad, are pulled ahead because of tariffs and other elements that people anticipate over the coming quarters. So I think you'll have selective areas where you see earnings revisions start to come into play, but it should rotate through all of them over the next 12 months.
Victoria, what's your reading on inflation and how big of a threat maybe this could be overall, obviously, to the economy, and then the trickle-down effect here just in terms of how the market should be looking at that risk?
Yeah, it's really interesting because if we look at the move in the 10-year Treasury, a lot of people assumed that was just inflation concerns driving it higher and then seeing it come lower too, having some of that back off. But it mostly was term premium. It wasn't really inflation that was concerning people. We've just started to see 5-year break evens move higher. So that's just starting to come back into the conversation. Is it tariffs that's driving that? I really don't think so. I mean, you can tell over the past couple of weeks, the market and investors are really kind of saying, we're not sure tariffs are going to be something permanent. It's probably a temporary move, and we could see some volatility in expectations, at least in short-term inflation expectations. But I think longer term, those are still pretty well anchored. And even though it's sticky because of housing components, because we've had wages move higher and new labor deals that will continue to see wages over the next couple of years, you will have those sticky components. But I'm not sure we're going to see the huge swings in inflation that some people are anticipating.
Victoria, thanks so much for taking the time here pre-market.
Thanks, guys.
Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, Palantir shares under pressure on possible cuts and a reported changing coming from CEO Alex Karp. And Alibaba surging as its cloud business surprises to the upside. Details ahead on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's take a look at shares of BABA. Alibaba shares, they are rising pre-market after reporting earnings for its December quarter. Alibaba reporting a 13% jump in revenue for its cloud segment. This follows the company's confirmation that it will be partnering with Apple to bring AI to China. CEO Eddie Wu saying in a statement that Alibaba expects, quote, revenue growth at Cloud Intelligence Group driven by AI will continue to accelerate, end quote. Shares are up by about 9.3%. They went on to say that they made some substantial investments trying to spark growth reacceleration in their core businesses, also maintaining some financial discipline, enhanced operational efficiency, and so forth, and also touted some of the results from Taobao and Tmall Group too.
Yeah, certainly. I mean, this really turned into a massive focus on AI, and I think that's really what is driving a lot of the gains that we are seeing this morning, this optimism that we are seeing play out here in the stock. Alibaba saying saying that they see more cloud growth seen in the next 3 years than they've seen in the last decade. And that was just not even scratching the surface. Eddie Wu also went on to say that it's a once in several decades opportunity. He was saying the pursuit of AGI, which is artificial general intelligence, is Alibaba's primary objective, which is interesting, just given the vastness and given the scale of some of their other businesses. So a real focus and a doubling down on artificial intelligence, on AGI specifically. Alibaba anticipating that if AGI can be fully realized, get this, it can contribute up to 50% of the world's GDP in the future. So again, very, very bullish on the capabilities of AI going forward, those future investment opportunities. And we certainly have seen Alibaba here add to some of those earlier gains, with the stock up now just over 9% ahead of the open.
Yeah, amazingly important here too on the e-commerce side. Let's remember, for all of the social media dominance and transformation that I should say, is moving a lot of customers towards purchasing in-feed. For Alibaba, for some of the Taobao and Tmall type of exposure that they do have, it's important for them to also maintain the amount of merchants that are continuing to use them as the first or go-to first platform for some of their sales here. And they talked about that within the strategic business updates this quarter, adding on 88 VIP members, highest spending consumer group as well, continued to increase by double digits year over year. So trying to bring in even more of the higher tier incomes, seeing some of the value on those platforms. And it comes back to the merchants that they're able to ultimately retain and then grow out that core user base for some of those who are putting their products listed on Alibaba's e-commerce platforms.
All right, let's take a look at Palantir, because shares is selling off once again today, falling after it fell double digits during yesterday's trading session. You're now looking at it off the lows of the session here of the morning, off just about 3.6%. But this also follows CEO Alex Karp's plans to sell up to 9.975 million shares by September. Now, shares also hit by reports that President Trump's Defense Secretary Pete Hegseth is eyeing 8% cuts to the defense budget over the next 5 years. That was the big driver of the stock's most recent move. Now, Palantir has contracts with the Defense Department, but let's put that in context, because I think this is so important just in terms of why Palantir is getting hit harder than many of its peers. And the reason why is that the government actually accounts for 55% of Palantir's total revenue. So much more exposure there to the government side of the business than many of its peers have. And just put in comparison, typically they have mid to high single digits exposure there for the government. So the fact that Palantir government accounts for 55% of total revenue, that is why we saw such a huge hit on the stock yesterday. That's why we're seeing further declines here today. And also when you just take a look at the recent growth specifically that we've seen within the government business, more than 40% in the past 2 quarters, obviously showing the fact that they have very much a large exposure to the potential defense cuts.
They do, but and on kind of the two-prong of the story here, one, on the executive package, essentially for Alex Karp to, look, notch some gains here at the end of the day for the company that he has brought to the market and ultimately been able to see the valuation grow up to this point. I mean, the shares were up. I think even with this move down pre-market, they're probably still higher by about 55% over the course of 2025 alone. So it's been quite the rise to start off the year. You have some of the bulls out there in Dan Ives of Wedbush continuing to say, look, you've had bears essentially calling this out, the exposure to the government, and the bears hating Palantir from $12 to $120 in the last 18 months, and now finding their latest quote-unquote silver bullet negative thesis. However, he continues to argue that this is actually more opportunity and not less for Palantir at a new Department of Defense. That in the note published from Wedbush's Dan Ives here.
Yeah, it's hard to kind of see that being a massive catalyst here for the stock over the longer term, but we'll see. But you're right. I mean, when you take a look at the 1 year chart, you're looking at shares up 350 or so percent here. So again, when you're putting that into context, obviously, then the dramatic moves that we have seen over the last 24 hours or so doesn't look as worrisome as maybe they initially do on the surface.
And to correct myself, I'm sorry, even with this move, essentially we're only up 49% year to date. So didn't want to give you guys 10% extra gains there, but at one point they had, and they have seen new all-time highs over the course of this year. Switching gears here, another company we've been tracking, NVIDIA earnings less than a week away, and leading up to the company's results, the street is still cautiously optimistic. Yahoo Finance advanced data shows NVIDIA's earnings per share trend drifting slightly lower in the past month. Analyst commentary ahead of the earnings is generally positive, but HSBC did lower its price target, citing pressure on NVIDIA in the second half of the fiscal year. NVIDIA lost nearly $600 billion in market cap after Chinese rival DeepSeek revealed its AI model earlier this year. You're taking a look at shares of NVIDIA. They're still fractionally higher here today, but of course, a lot of that move that we're going to be keeping close tabs on is going into next week. That earnings report, February 26th, and I've been looking at some of the options AI data where it looks like the expected move from this point to post earnings is an expected move either higher or lower of about 8.4%. So that's kind of the general barometer, or perhaps, measuring point that we'll guide up against at this point.
Yeah, and I think that's pretty much in line with what we have seen in most recent quarters. Yes, maybe you can say the street is getting a little bit more cautious, but when you take a look at where these analysts stand in this write-up that we have on yahoofinance.com by Brian Sazi, there's still buy ratings across the board. They are very bullish about the NVIDIA story over the longer term, and I think that has been bolstered a little bit by some of the hyperscaler results that we've gotten out over the last several weeks, showing the fact that they remain committed and don't see that shifting anytime soon in terms of some of their spending on AI and the bulk of that spending, what exactly that is going to look like. Bank of America analyst Vivek Arya, he has a $190 price target on the stock, reiterated his buy rating, saying that they do expect a fourth quarter beat. The first quarter outlook, though, could face some headwinds, but looking here past some of that, talking about the fact that they do see momentum in the stock, investors are going to be looking forward to NVIDIA's leading new product pipeline, that total addressable market expansion. That is enough here for many of these bulls to remain optimistic about the quarters to come.
And we've been talking about DeepSeek as a detrimental force for NVIDIA. There was actually a Macquarie note that mentioned that if the reduction of costs could be seen through some of the competitors like DeepSeek, that could essentially be the catalyst needed for democratization and mass adoption of AI here. And potentially for NVIDIA, what that could mean is even if you do have this democratization and a mass adoption of AI and reduction of costs, then there's still going to be more use cases for NVIDIA. People are still going to need to buy into chips, and companies are still going to need to build out more data centers. So as much as there was this incremental hit to make the market think about, all right, how much froth is already out there, or how much will new competition disrupt the existing thinking about the entrenchment that some companies have, there still is a potential benefactor play here for NVIDIA as well. And I think that's what Macquarie was also noting here. So we'll see how some of the other competitive players certainly disrupt the thinking around the AI trade.
Well, all right, keep right here on Yahoo Finance. We got the opening bell when we come back.
That's a live look at the opening bell on Wall Street and in Midtown Manhattan. At the Nasdaq, you've got Lam Research ringing the opening bell. And at the New York Stock Exchange, you have Columbia Threadneedle Investments ringing the opening bell there. All right, two great bell ringers on both sides. Let's take a look at how the opening cross transpires here on the day. Taking a look at the Dow Jones Industrial Average, we are down right now by about 0.4% to begin today's trading activity. The S&P 500, let's put a chart up there for you just so you could see what the movement has been like over the course of this week. And there we go. As we're taking a look at that move yesterday, that was your all-time high that we were able to notch here. And the larger question is, can we continue to build on that from here? 4.25% higher to start off 2025 here. And let me just put this on a 2-day view so you can kind of see exactly some of the moves that have taken place there for the S&P 500, though fractionally down out the gates this morning. All right, that's not going to populate for me. Let's move on over to the Nasdaq Composite. You had a chance, S&P 500. Nasdaq Composite down by about 0.1% right now. Let's take perhaps a look at the S&P 500 sectors. Let's see if that cooperates. Yes, it does. 11 sectors here up on the screen for you, and we are down across the board. The worst of decliners right now is staples. That's lower by about 1% to start off today's trading activity. Let's take a quick gander at the Nasdaq, as technology is the least of the laggards, if you will. Taking a look at the Nasdaq 100, the tech-heavy average here, we've got 100 of the components there, and Apple, NVIDIA, and Microsoft fractionally higher to start off today's trading session. Got a deep decline here on Palantir to start off the activity. It's lower by about 7.9%. And then additionally here, let's just take a quick look at some of those Dow components as we're checking in on our friends here, Walmart, and that's down by about 4.5% post earnings. We've got much more on that conversation with Oliver Chen in just a little bit, so stick around here on Morning Brief. But for a deeper dive into today's early tape, let's get to Yahoo Finance's Jared Blickery for a look at what's moving. Hey, Jared.
Well, thank you, Brad. As you said, S&P 500 coming off a record high. So is the Nasdaq, and this is kind of the way markets behave in a bull market, and that is incremental gains, very slow action. But here's the Nasdaq. You can see it doesn't look like a lot of it is happening over the last 3 months, but we are seeing a breakout. Doesn't look like the S&P wants to cooperate, but we are finally seeing just a slight acceleration out of the trading range. Excuse me. And we have been hitting record highs for a couple days. Bond market and dollar aren't doing too much. Do want to point out that the dollar is actually dropping the most in a week, but not at significant levels. This is a year-to-date price action. You can see going in the right direction for risk assets. And let's get back over to the sector action. That was a lot of green there. A lot of red there. It looks like healthcare just flashed in the green very briefly. But Walmart leading Staples down. Staples is the worst off here. That is a defensive sector. So is utilities. And then we get into consumer discretionary, the other retail sector. But defensive leading down, and we're not seeing a whole lot of price action return-wise to the downside. Not any dark red, so not too concerning there. Looking over to the Nasdaq, wanted to highlight that we've got more red than green, but the mega caps kind of split themselves, so not seeing a lot of definitive price action here. And let's go over to China. That is a really interesting story. We've been talking about those BABA earnings here, but I just want to show you the big picture. This is a very green board, and I have a lot of the components, not all of them, but a lot of the components of the Nasdaq Golden Dragon China index here. And Alibaba up 11%. That is the best day in several years. That is not even the best performer in this group. We have VNet up 20%, Bilibili up 18%. List goes on. Couple stocks in the red here, but let me just show you what happens when we put the year to date on. We've got one here, Yi up 1,190%. And a lot of people were saying China's uninvestable. There's a decent argument to be made that the government there has been very arbitrary in the way they've treated investors in the capital markets over the years. I get that, but nevertheless, you can't argue with price action. These prices have been screaming higher this year. Want to focus and close with the futures market? I'm going to go back to an intraday look. Here we have natural gas just hit a multi-year high, but then it's selling off. And let me show you the 5-year chart. They call this future the widowmaker just because of in the highly leveraged world of futures. We'll see if we can get the chart up here. Here, that's a 5-year chart, and there's that multi-year high after the decline. Something you definitely want to keep your eye on, because when natural gas prices spike, they tend to go pretty quickly, especially in the upwards direction there. I'm going to leave us with gold, and I'm going to be doing a deep dive on gold in about 30 minutes here. Gold just hit another record high. Let's see if I can find the ticker, GC equals F, up 0.5% today. This is also a 5-year chart, and you can see broke out of the base basically at the beginning of last year, hasn't looked back, and this is, I believe, the 11th record high of the year. Still short of 3,000 though. We'll put up a nice banner when that happens, guys.
All right, Jared, looking forward to that. I'm looking forward to your deep dive there later on this hour. All right, Walmart shares falling more than 5%. It's the biggest drop that we've seen since November of 2023. You're now looking at losses actually of just about 6%. Now the stock under pressure following the retailer's full year guidance that fell short of the street's expectations, and that cautious forecast raising some questions about the resilience of the U.S. consumer. Joining us now, we want to bring in Oliver Chen. He's TD Cowen's a senior research analyst. And Oliver, there is a lot to unpack within these results. Let's just first start with the stock reaction here. You're looking at losses of just about 6% at the open. Is that justified to you?
Well, the big story here is the PE multiple is very high at Walmart. It's 38 times versus a 3-year average of 24 times. So expectations have been very high as this stock's really worked well. What's really happening is the guidance, and people are responding to the guidance. The guidance is a little softer than street expectations. However, we're encouraged that this is conservative and in line with the past in terms of how Walmart guides. And this was a solid quarter, a very stable consumer they're seeing. General merchandise was up low single digits, second quarter in a row for this to happen. Also, general merchandise unit sales were solid, and the comp was better than expected for the quarter. So the stock is weaker on both valuation and guidance. That being said, this company is hitting on all cylinders, including low prices plus technology, digital advertising, and the marketplace model.
Oliver, we know they had something to say about tariffs. We know that you're running the calculus around what this will mean to the business. What is your kind of early estimation about any headwind that could apply to Walmart?
Yeah, part of the guidance is just commenting on this very dynamic environment. So what's going to need to happen is some will be passed through to consumers and some will be eaten by companies in the form of margins. That being said, Walmart is a real leader in rollbacks or discounts or negotiating with suppliers. It also has a more modest percentage of exposure to imports than Target and some others. So those are things that we like, and bigger is better. We think cash is king, and owning these bigger retailers that are executing globally, it's a great place to be.
Oliver, when you take a look at the impact that this is even having on its competitor Target, when you take a look at some of the dollar stores that are lower this morning on the back of these results, I guess, how do you see those spending trends at some of their competitors comparing to this, and whether or not this is a signal maybe of more of that weakness to come?
Yeah, I think we're going to see cautious optimism with lots of cross currents. The story for retail this whole past year has been winners and losers too. And as you think about Walmart, they're executing so well on the supply chain, on curbside pickup, on delivery, on AI. It's really hard for everybody to do this. So they're outpacing others. They're taking share from the dollar stores, particularly because Walmart's offering low prices plus lots of convenience. In addition, they're getting higher household income customers. So I think you're going to see winners and losers. It's going to be very difficult for companies to inflect this year, given this cautious optimism, and it won't be winners around the board. We'll see. The consumer still being considered in their purchase, looking for strong values and looking to consolidate, and still focused on needs. A little bit of inflation too, 1 to 2%. It should be normal, hopefully, but some spikes in certain areas like dairy too.
Oliver, you got a lot of people lighting up the Yahoo Finance platform, perhaps using some of those charting tools and looking at moving averages here today, trying to figure out whether or not it's safe to buy Walmart on a pullback like this. What is your evaluation?
We're encouraged. However, I would say as analysts update their estimates overnight, given that it was lower versus street by about 8%, people do have to revise their estimates to this new bar. That being said, this company is consistent and the consumer is consistent. So it's well positioned for a beat and raise, and we certainly like it for the longer term. The other thing to pay attention to, of course, is alternative revenue streams, meaning digital advertising and the marketplace model. As you think about the third-party marketplace, there's only 700 million SKUs at Walmart. There's about 5 billion at Amazon. Also, digital advertising is a big growth opportunity, particularly as the marketplace grows too. That will help margins grow faster than sales. And this retailer has over $9 billion of cash as well. So you're getting a lot of great characteristics, but the near-term estimates need to become a little bit softer. So we'll see.
Oliver, is that going to be enough to offset then some of that weakness if we do see any sort of weakness related to tariffs?
Yeah, I think that tariffs will be something to watch. It's so dynamic, and the consumer and inflation and circular issues in terms of how this pressures consumer confidence. But what we are thinking is there's a real barbell opportunity, meaning we upgraded Cartier and Richemont. We're seeing the wealth effect at the very high end. And then these retailers that can execute to exceptional value, low prices, rollbacks, they will be better positioned because customers will trade down into places like Walmart to get that everyday low price. And that's great across all cohorts. At the same time, you don't even need to go into the Walmart store to experience this. The marketplace, curbside pickup, and those are very expensive operations to run. Walmart's doing it better and better with more profitability on e-commerce. That's another positive too. But it's not a cheap stock, 38 times PE. You can't forget that. We have a buy rating. We like it for the long term, and we like this whole flywheel between technology meets value meets grocery leadership.
What does that mean for the luxury end that you were just talking about a moment ago here? Because you do have a lot of luxury brands trying to figure out how they can go unscathed from tariffs that might hit their business, thinking about some of the European brands, some of the international brands that sell into the U.S. luxury consumer right now, and all the deal making that's also started to take place. Yesterday, we saw two, I think, big deals, at least in my mindset, that are going to change the aisles that people shop in. And Stuart Weitzman going to, what is it, I forget the name. But anyway, some of the big deal making that took place in luxury yesterday as well.
Yeah, Brad, luxury is going through a lot of change. There's a lot of industry consolidation in luxury, so the biggest players are quite large. Our pick here is hard luxury is working, meaning jewelry, gold, and aspects of rings and diamonds. The real beneficiary there is Richemont. The big caution for luxury is China, and China's housing market, as well as this dynamic situation between the U.S. and China, is impacting consumer confidence and spending in the real estate market. The big winner in luxury is the U.S. market, and the wealth effect and the resolution of the election happening added a lot more confidence. That's a nice positive for what we're seeing with spending patterns at the high end. Lots of changes, though, creative changes in terms of at the major fashion houses, and we're still in a bit of a boring, quiet luxury phase where people are yearning for more fashion. So a better picture probably in the back half, but mixed in luxury, you have to be pretty selective. U.S. better, wealth effect, consumer confidence, the last 12 months of S&P 500, those are all positive for the higher end.
Caleres was the word I was trying to remember, Oliver, and Stuart Weitzman, Caleres deal. Yeah, just wanted to clarify that for our viewers. Oliver, it's always a pleasure to grab some time with you and get your analysis. Appreciate it.
Great seeing you both. Thank you.
Likewise. It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at jobless claims in the nation's capital. Hey, Maddie.
Hey, Brad, a big question. Is the Dojification of the workforce going to cause some cracks in the labor market that the Federal Reserve is going to have to contend with? One way that we can suss that out is by looking at jobless claims in those states that have the highest proportion of federal workers. Torsten Slot getting us this chart here showing a little bit of an uptick in states like Maryland, Virginia, and D.C. But as of this morning's jobless claims, we actually saw all of those states being decliners on initial jobless claims. So we're seeing this chart, actually, if you continue it out to current levels, moving to the downside here. And what's really interesting, I spoke with Claudia Sahm about this, talking about this idea that we would have to see a broader sickness in the labor market in order to see some of that Doge cost cutting and firing of federal workers actually impacting the labor market. But one of the bigger questions is, what will company CEOs do when it comes to hiring? Will they put a hold on CapEx for hiring moving forward amid all these questions about the impact of policy? If we see that slowdown in hiring combined with layoffs in federal federal workers. Federal workers, by the way, made up 35,000 workers in last year's jobs data. Could that lead to a broader sickness in the labor market that the Federal Reserve would then have to contend with, guys?
All right, Maddie, thanks so much. Well, coming up, making Meta more accessible to retail investors potentially, why the tech stock could be headed for a potential split. We've got that coming up next on Morning Brief. Meta pulling back after a record 20-day win streak. The recent rally could have some investors start calling for the company to split its stock for the first time since going public. You're looking at a 1-month gain here of just about nearly 15%. We want to bring in Ron Josie. He's Citi's senior analyst of internet equity research. Ron, I'm curious how you're looking at the recent record gains that we've seen in Meta and whether or not maybe it could be headed for a split.
Yeah, split, no split. It's you never know what happens there. I would just tell you from the record gains or the continued growth in the stock, and obviously it's pulled off a little bit last few days. It's you don't have to look any further than the results, and also where they're investing, and they're investing in significant hardware, software improvements, given all the opportunities within AI. And frankly, they're one of the few companies where we're seeing these investments turn into revenues. And so when we take a step back and split, no split, just from a fundamental perspective, we're seeing advertisers increasingly allocate more spend to Meta. We're seeing, most importantly, usage and engagement grow. And as long as the usage continues to be strong across, whether it be Reels or the feed or stories, or as Meta AI actually gains users, as Threads gains users, all these different platforms, as engagement grows, that creates greater opportunities for advertisers to reach their audience. And I guess at the end of the day, what's driving the move on Meta, and frankly, it's our top pick. It's more advertisers finding more surfaces and being able to really target users and generate that return on ad spend that's needed. And most importantly, not only are we seeing top line growth, but we're also seeing that bottom line hold up pretty well, and that the year of efficiency has continued. We like to say it's a year's or it's still day one on Mark Zuckerberg's year of efficiency.
Interesting, and especially as they're calling it a pivotal year for the metaverse. And so how should we think about all of those elements that you laid out as that relates to what they're prioritizing in this pivotal year for the metaverse?
Yeah, I mean, look, the metaverse, I think, whether it be the metaverse or is it mixed reality or whatever it is, I would just tell you first and foremost, I think they found a hit on these Meta AI glasses with Ray-Ban Meta glasses. And so, frankly, that's driving a lot more adoption of Meta's hardware, which is really interesting. When you take a step back and you think about the broader business, primarily it is core social, it is engagement, and it is monetized via advertising. That's your highest margin that's in the business. And frankly, although they're investing in reality labs in the metaverse, I think margins can actually continue to grow within their core family of apps business, which is their core advertising business, as they invest in these newer opportunities. And so whether it's a year of metaverse or not, I think these Meta Ray-Ban glasses are pretty interesting. Regardless, we're seeing greater usage across all of their products that we think can drive greater profitability overall. And that's what really matters here.
Ron, what about the overall AI trade? The fact that it has lost some momentum. There was initially some concern following the developments out of DeepSeek, very much debated. And I think also widely, maybe there is consensus, obviously, that it could be bullish here in the long run. As you look ahead to NVIDIA, not asking specifically about NVIDIA, but how critical are those results to the overall momentum of the AI trade?
Look, I can't really opine on NVIDIA, but I will say that when you think about what Meta is spending on CapEx, whether between that 60 to 65 billion, what Google or Alphabet is spending upwards of 75 billion, what Amazon is likely doing over 105 billion on CapEx, there is a massive investment cycle going on here, given the opportunities within AI. Now, of course, not all of Amazon's 105 billion are related to AI. They do run a pretty interesting, successful e-commerce business. But point being is, the way we're thinking about the internet today and how we interact with apps could absolutely change. And it could change for the better, in that we could see greater engagement because, these apps, and take Meta AI, for example, these agents become more in tune to what we're looking for. And so it's the race to basically win that engagement. And the investments that we're seeing, I don't think they let up anytime soon. And as we take it back to Meta, with 700 million Meta AI users on the path to that billion that I think CEO Zuckerberg's been talking about, that creates a wealth of opportunities that's brand new. It's a new surface that Meta's talking about, new potentially search and other things that come down the pike. So we're in the early days of the AI opportunities here.
Ron, just lastly, while we have you, we got to ask about Carvana as well. Shares taking a hit here on the day post earnings, and the company still did see full year sales hit 416,000. That's up 33% compared to a year ago. What is it that investors are not liking about this report?
Yeah, I mean, look, not only was 2024 a great year, they exited 4Q growing their units 50%. They have 17 plus million monthly unique users. They're becoming more profitable with every single sale that's happening here. And so, look, there's a little bit of focus on what they call the gross profit per unit, which was down sequentially in 4Q. But that, in our view, is mostly seasonality. When we take a step back and think about Carvana, look, the growth in units, in our view, continues to be very, very strong. And as they become the leader, or call it one of the top used car dealers in the US, I think they have a wealth of opportunity to not only continue to gain share, but become more profitable. And frankly, I look at the shares down today on potentially, weaker GPUs, which is gross profit per units, which could be seasonal. I look at it as a buying opportunity.
Yeah, if you ask them, they'll say that they are the most profitable public automotive retailer in the U.S. history, as measured by adjusted EBITDA margin. Ron, thanks so much for taking the time here with us today. Appreciate it.
Enjoyed it. Thank you.
We've got all your markets action ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, Birkenstock shares lower after posting first quarter earnings. It was a top and bottom line beat for the footwear company, with revenue growing 19% from a year earlier. But direct-to-consumer revenue that fell well short of estimates. Shares are down 5%.
United Healthcare offering buyouts to some employees in its benefits unit if they quit by March 3rd. That's according to a report out from CNBC. Now, sources telling CNBC that workers who don't accept will continue in their current role or a comparable position. But if the provider doesn't meet a resignation quota through buyouts, it will then conduct layoffs.
Finally, Grab Holdings, the Southeast Asian ride-hailing and food delivery company, falling after reporting weaker than expected full-year guidance. The company's CFO confirming to Dow Jones the guidance is conservative since it's early in the year. Grab did miss on operating income in the fourth quarter, reporting $2 million versus the $8 million plus that was expected.
Well, that does it for Morning Brief. And keep it right here on Yahoo Finance. We've got Catalyst coming up next.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's take a look at the three catalysts that we're watching this hour.
First up, we'll break down the market action as Wall Street casts caution on the latest rally.
Plus, from trade to tax cuts, we'll break down what the latest developments out of Washington mean for investors.
And a challenging fundraising environment has venture capital under pressure. We'll discuss all that and much more on Catalysts. U.S. stocks pulling back this morning after the S&P 500 hit a new record high, the third of the year. Scott Kronert of Citi warning the near-term high is likely due for a pullback, but he does add there's no change to the long-term outlook. Here to break it all down is our very own Josh Schaefer. And Josh, I can't wait to get your thoughts on this note because I thought it was kind of interesting. He sounded like Jay Powell to me, like leaving himself open to potential rally, potential move to the downside, not sure where the market is heading.
Yeah, it seemed like what Kronert was highlighting to me is essentially a lot of the good news in terms of Trump policy feels like it's priced in at this point, and especially in terms of tariffs, right? I think a lot of people I've been speaking with recently have sort of had this thought where it seems like the market at this point has priced in that 25% tariffs on Mexico and Canada are largely negotiating tools. So the fear would be, what if they're not a negotiating tool, right? And what if those tariffs actually do come to fruition in the next couple of weeks? I think we saw perhaps the last time we got near the tariff deadline at the beginning of February, right? We had sort of that overnight sell-off. We'll call it a sell-off. Stocks were down about 1%. But for us in this market, a little bit of a sell-off, right? But then that sort of faded as the day went on, right? And we found out that the tariffs were getting delayed in Mexico and then the tariffs were getting delayed in Canada. So it seems like what Kronert is essentially saying here is the upside surprise is probably already priced in, and really you probably only have downside surprises to come in terms of tariffs if we do actually get full tariffs. But as you point out, Maddie, I think overall the takeaway also being he thinks that doesn't necessarily mean that the S&P 500 would be in trouble for the entire year, more so talking about perhaps a short-term drawdown.
Yeah, and I think a lot of this just points to so much uncertainty that's out there. And one of the things that we've been talking about, obviously a theme, and it was also a theme in a recent survey of CEOs and business leaders, just in terms of the fact that they are maybe a little bit worried about what the future could bring, but they are overall optimistic, which I found a bit perplexing, just given some of the headlines and given the fact of the lack of deal activity, for example, since the start of the year, would make you think that maybe they weren't as optimistic as they
Yeah, so the Conference Board survey of CEOs was out this morning, Shauna, and it hit its highest level. The overall index hit its highest level in 3 years. Pretty large jump you're seeing on your screen there all the way to the right. And what was sort of driving that, it seemed like, was, again, as you said, optimism on the current economic outlook, optimism on the next 6 months, which I found rather interesting, that they think the next 6 months is actually going to be better. I don't know if a lot of economists think the next 6 months is necessarily going to be better, perhaps maybe the same and not worse. But other key takeaways from that for me were sort of the overall employment situation that was highlighted in there, more signs of kind of the low hire, low fire environment. A lot of CEOs plan to hold on to their workers, which is good news for all of us that have jobs, right? And as Jay Powell said, it's a good environment where you have a job, right? And CEOs are planning to also raise wages for those workers, but they're not planning to hire. Less CEOs saying that they're planning to hire in the next year overall. So it seems like, again, kind of steady state right now. But again, I would sort of say the bad cut here would be if they felt like they were going to be firing people, right, or laying off workers or cutting back on the workforce, and they're not. So I think overall a positive spin from CEOs, which is a little bit different than what we've been seeing from consumer sentiment.
And a lack of hiring is tough when you have a record-breaking layoff happening to the federal government and the impact that could potentially have. I do want to switch gears a little and talk to you about this line. Kronert saying the Magnificent Seven will contribute but not lead the market gains. What is the leader then? Is it a specific sector or is it just general individual stocks keeping us afloat?
I mean, it seems like we'll go, if it's not the Magnificent Seven, it's definitely the 493, right? Within the 493, I mean, a lot of strategists right now are still talking about financials. They seem to like financials, right? If you're going to stay in tech, that AI software trade has also been doing very well to start the year, and that's been an area of the market that strategists seem to like. But Maddie, to Cronert's point, I think, again, what he's getting at with, if we have less Mag 7 contribution, it's going to be a different ride up than what you've had the last 2 years. You got the rally of over 20% for 2 years in a row because these giant stocks were contributing a lot to the S&P 500's gains. I know Arshana Smith highlighted yesterday in her chart of the day, those companies are not contributing as much, right? And so if you don't have as big of a contribution to the index from the Mag 7, you get a little bit of a smaller gain, right? We don't have NVIDIA driving up this index right now.
Yeah, which I think is so interesting. And then that also begs the question whether or not market breadth is good for the market, it's bad for the market. There are some contrarian takes out there that are starting to emerge, and just talking about the fact that it's going to limit some of that upside, just given the fact that it won't have that outsized impact as big tech.
It depends on what you own, right? It's good if you're a stock picker, right? And that's why strategists love to talk about it, because they love to be stock pickers. Yeah. And there are more companies, as we've been highlighting this week, there's almost half of the index is outperforming the index thus far this year. So there's more opportunity if you're going outside of just the Mag 7 to find a company that's going to do better than the index. So if you're looking to be that kind of investor, it's perhaps, if nothing else, just a more entertaining market to be an investor in. You don't just have to own 7 stocks and say, well, I don't know where else to go. There's other opportunities within the market.
Could make it a little bit more challenging to find those winners.
It's not easy to stock pick.
All right, Josh, thanks so much. Let's take a look at gold, because gold actually hitting a fresh record. It's the 11th intraday high of 2025. That's according to the data that we have here at Yahoo Finance. Geopolitical tensions, tariff risks are continuing to persist. That's adding some of that safe haven mentality. Markets and data editor and host of Stocks and Translation, Jared Blickery, joining us now to break it all down. Jared.
Thank you, Shauna. What a great day to talk about gold. As you mentioned, lucky number 11. That is the 11th record high of the year. And the chart, if it shows up here, you're going to see you don't get a much more steady chart than what we have in gold since the beginning of the year. Here's 3 months, and you can see up 12% in that time range. And I just want to point out, we are still short of 3,000. This was a high this morning, 2,973. It's $20 off of that, but we just keep inching closer and closer. And I want to show you how gold has been on investors' minds recently. This comes from the Global Fund Manager Survey done by B of A once per month. And this is the top currencies that investors expect to outperform in 2025. So this is a prediction. I want to point out that US dollar is still number one, 31%, but that has been on the decline over the last several months. Japanese yen, we don't talk about that a lot. That is on the increase. That's up to 30%, threatening to take over the dollar. But gold has been rocketing higher too in the survey, and that is now at 25%. So gold, definitely one of the most important currencies that the world has its eyes on this year. And it's not just individual investors, it's not institutional investors, it's not the retail gold buyers, it's really the central banks who make the biggest decisions with respect to gold. They have been buying the most of it. And when I think of that, it's China and Russia over the last 10 years. But this is really interesting because this comes from the World Gold Council. This is the 2024 largest purchasers. And guess what? Poland is number one, over 80 tons. Turkey, number two, pretty close behind. India, close behind Turkey. And then China, over 40 tons, that's number four. But let me show you how China has been adding to its gold reserves over the last 3 years. This chart goes all the way back to 2010. In 2011 was when they really started ratcheting up the purchases. And you can see they were adding over 400 tons per year. That's this white line right here. Then in 2021, they just started, or 2022, they started blowing that away. 22, 23, 24, almost double that. We're looking at 1,100 tons per year. So getting back to our original premise here, what is gold going to do this year? I think it's an easy bet that it gets to 3,000, but I just want to show you historically what it has done in times of trouble. It's not only an inflation hedge, but also somewhat of an Armageddon hedge, but it's also a little bit misunderstood. In 2008, we did have a pretty big downturn in the midst of the global financial crisis. And so gold suffers from deflation. It is kind of a risk asset, even though it's also a bunch of other things. But then we saw the peak after the QE era in about 2011, 2012, still had some strength around $1,800. But then as the Fed started, kind of winding down QE and it started tightening, we didn't really see gold take off for a number of years. Here's a pandemic, and then we finally got this breakout here. Based on history, we've got a ways to go. We'll have to see where we end up.
All right, Jared, thanks so much. Keep it right here on Yahoo Finance. Coming up, the policies impacting chip companies. We will be speaking with the CFO of Lam Research. He joins us next following their Investor Day. We'll be right back. Uncertainty continuing to surround chip stocks as investors weigh the effects of policy changes with stricter U.S. export controls and potential tariffs on the way after President Trump proposed 25% tariffs on chips. Joining us now, we want to bring in Doug Bettinger. He is Lam Research's Chief Financial Officer. Doug, it's great to have you here back on Yahoo Finance. So the last time we spoke was just about 8 or 9 months ago. You were telling me that supply, that demand looked very, very strong. You were very optimistic about the remainder of what we saw last year, also heading into this year. I'm curious, just with President Trump and the Trump administration now in the White House, does that at all change that demand dynamic?
You know, at this point, no, it really doesn't. You know, we had our first Investor Day in 5 years yesterday. We talked about what we see into the future. You know, the government regulations that are there kind of feel like we're in a steady state pattern right now. So at this point, no, nothing new that we're aware of.
Speaking of the demand question, though, it's been interesting to hear from CEOs and executives, even at the likes of Microsoft, saying that the chip shortage is coming to an end. How does something like that impact your business?
When we look into this year, frankly, it's going to be a pretty strong year for semiconductors. You've got all of the demand that is originating from the AI investments that are occurring. That requires a lot of semiconductor content. And frankly, we supply the equipment that manufactures the chips. And so when we look into this year, it looks like a pretty good year, to be honest with you.
What does that demand more specifically look like then, Doug? The growth opportunity, how that compares to last year?
Yeah, no, we see growth in the things that we do. It's up mid-single digits relative to where the investment in wafer fab equipment looks to be trending this year. And that's investment that generates all of the leading edge chips in the industry. And so we're feeling really good about where things are trending right now.
In your conversations with customers, how do you drive them to upgrade when you offer new tools like the ones that you announced at your investor day? Because you could argue that once they have your existing tools and TSMC is able to utilize your tools to make the chips that their customers want from them, why would they spend the money to upgrade?
The need to continue to innovate with leading edge capability, higher performing chips is always there. And that's actually what a lot of our equipment enables. And frankly, that's what we see going on, right? All of our customers are moving to that next process node to get the next level of performance. AI is driving a lot of that right now, but the demand for semiconductors, broadly speaking, is actually quite good this year.
Doug, how difficult is it to give guidance and to really navigate a time where there is so much uncertainty coming from Washington?
It originates from conversations with customers, right? We understand where they're going. We understand what they need. We understand what their roadmaps look like. And frankly, that is the basis of trying to understand where business is trending. And honestly, if I can kind of point to a little bit of what we talked about longer term at our investor day, those conversations with customers are requiring us to make investments to grow the business as we look forward over the next several years. We're very excited about where things are going.
Doug, have you been having any sort of conversation with the Trump administration or your peers even within the industry just in terms of how the next several months, several quarters could potentially look?
Yeah, listen, we've got a very strong government affairs team. That's their job, that's their role. Conversations are beginning, but what I would tell you is it's early days at this point.
Right, but we have you here with us now, Doug. What are those conversations looking like? Can you give us anything?
Yeah, like I said, early days, too soon to comment on any specifics.
All right. Well, I also want to talk to you about something specific, which is the United States relationship with other countries, specifically when it comes to rare earth minerals, something that the Trump administration is trying to reach a deal with Ukraine currently. It's obviously been an issue with China and their control of exporting of those rare earth minerals that, in my understanding, are utilized in some of your products. How have you shifted and strategically thought about shifting your use of those minerals ahead of any of those tensions that could escalate concerns about your ability to get access to the materials that you need for your chips and your tools?
Yeah, frankly, we're able to get everything that we need, honestly. We've got a very capable supply chain organization at the company. Really hasn't been a significant problem for us, to be honest with you.
Doug, when you talk about that strong demand, I'm curious, just where is that coming from? And what do you see driving that here in the months to come?
Yeah, honestly, when you look at like the new demand driver that we see in the industry, frankly, it's coming from AI. All of the GPUs that enable AI training and increasingly moving to the inferencing side of the house, the ASICs, the low latency DRAM, high bandwidth memory, all of those things need next generation capability. And that's what we talked about at our investor day yesterday. We look forward over the next 3, 4, 5 years. And honestly, we see the opportunity to double the size of our company from a revenue standpoint and more importantly, from a profitability standpoint. I think yesterday, that's what got our investors very excited about what's going on, specifically with our business, driven by what's going on in the industry. Great roadmap ahead of us. And we were excited to announce 2 new products yesterday. A product we call Akara, which is the first bottoms-up redesign of our conductor etch tool offering, as well as a tool we call Halo, which is going to enable the next evolution of metallization in the industry. Super excited about the strength of our product portfolio and what that's going to do for us as we go forward here.
If you look at the stock on the Yahoo Finance platform, you can see the PE ratio at 27. Investors excited about how cheap the stock is compared to the rest of the semiconductor industry. So we'll certainly continue to monitor all those company developments. Doug, thank you so much.
Excellent. Thanks for having me today.
Now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Mercedes-Benz expecting a challenging year ahead, announcing plans to cut costs after sales fell 4.5% year over year for 2024. Yahoo Finance executive editor Brian Sozzi spoke to Mercedes CEO specifically about President Trump's proposed 25% auto tariffs. His message to the administration is to not forget how much the company has invested in the U.S. here, saying, quote, "We are also an American company. Yes, we have our headquarters in Germany and we have European origins, but we feel American. We are prepared to continue to invest billions, and we want to grow our footprint in the United States." That is really interesting in the context of their EV sales in particular, which were under pressure in the United States, under more pressure globally. If you take a look at Europe, we saw those sales declining by 4%, the growth just decelerating in the United States, and the guidance indicated that growth was only going to continue to slow. There was no evidence of an EV snapback in the cards for Mercedes. So something else that I am thinking about here is not just the impact on Mercedes, but also if we can pull up Tesla stock, you'll be able to see that stock is also under pressure, even more so than Mercedes. Last time I checked, you can see Tesla's down about 2%. So potentially a little bit of a read through to Tesla when it comes to that demand.
Yeah, certainly. And I think this just very much focuses on production costs and the ability here for many of these larger automakers. Obviously, when it comes to Mercedes specifically, the ability to lower those production costs in a timely manner and what essentially that looks like and how much more complicated that is going to be under the potential threat of new tariffs. And specifically when we don't know, when there is so much uncertainty just about the scale and scope of these tariffs, what that's going to look like, lays out what has really been, I think, a critical challenge here for the industry. And we've heard so many CEOs talk about this within the auto industry, even here in the U.S., just about the fact that it is tough to plan here for the next several quarters and next several years, just given some of the changes and the whiplash that is coming out of Washington. You're also seeing that reflected in the global auto market as well. So again, when you talk about the fact that margins could be under a bit of pressure here, you talk about the fact that the company expects margins to be between 6 and 8% in 2025, looking ahead to what that could potentially look like in 2027 if they are able to meet those cost-cutting plans that they do plan to do. So again, I think it very much just begs the uncertainty question, and I think that very much just shows how fragile this industry is potentially in regards to some of the policy that's coming out of Washington.
Especially to your point, because costs were already such a concern.
Yeah. All right, let's take a look at Disney's planned deal with Fubo TV. It's actually under scrutiny. According to a report coming out from Variety, Democratic Senator Elizabeth Warren is raising some questions here. She's urging the Justice Department to investigate the proposed acquisition, saying that it's, quote, another attempt to dominate the sports streaming marketplace and should be regarded as another data point in Disney's history of anti-competitive behavior. Now, in January, Disney announced that it would merge its Hulu Live TV service with Fubo. They would also take a 70% ownership of the combined company. You're looking at both stocks under a bit of pressure here today, but taking a look at what Elizabeth Warren said even more specifically, a lot of it was surrounding pricing and what that could potentially expose here for some consumers, saying that this proposed acquisition raises significant concerns under antitrust law, will give Disney increased market power and some of that incentive to increase costs for viewers. Also regarded the fact that she said that Disney has a history of some of that anti-competitive behavior. It's also important to point out this isn't the first time she's raised some of those questions, some of the concerns regarding this. So again, it's more of a double down of what we have heard her say in the past.
I think it's fascinating, given what we heard from the Trump administration this week, that they're going to continue what they called Biden-era regulation. Does that mean that the Trump administration is going to be on Senator Warren's side when it comes to pressure on acquisitions and mergers like this? It's going to be really interesting to see that. One thing that I'm just familiarizing myself with here is that this ended that lawsuit that Fubo brought against Disney, Fox, and Warner Brothers because they were planning their own sports streaming service that would have been competitive against Fubo. And then Disney said, well, let's just team up, Fubo, and then you don't have to sue us. And that's the question that Senator Warren is raising here, along with some of the other concerns that you pointed out, Shauna, just that it does continue what she calls a history of Disney's anti-competitive behavior. So I think it's going to be fascinating to see how the Trump administration responds to this.
Maybe they'll find some common ground on this.
Maybe they will. Maybe they will. All right. Well, we will continue to cover all your markets action ahead. So stay tuned for that. You're watching Catalysts.
Let's take a look at shares of Palantir. You're looking at the stock off almost 10% here in early trading. The declines coming after the drop that we saw yesterday that initially came on reports that the Defense Department is making budget cuts. And also we had the news that CEO Alex Karp is adopting a new stock trading plan. That, of course, adding maybe to some of the pressure here today. But again, I think a lot of it has to do with the spending cuts when it comes to the U.S. government, the importance that that is to Palantir's business. And here's why. When you take into account just how important the government part of the business is to Palantir, making up over 50% of its revenue, very much a lot of the growth within Palantir that we have seen has come from government here, more than 40% growth in the past 2 quarters. So they have that great exposure to any cuts in the U.S. defense budget, more exposure, you can make the argument, than many or all of its peers here when you take into account that much of their exposure is in the mid to high single digits here. So again, the fact that they do have that the government accounts for 55% of their total revenue here just really shows just how big of a hit maybe this could potentially be. Of course, there are some contrarian calls out there, Maddie, when it comes to Dan Ives, saying that this actually could be a catalyst here for the stock in the long run. But at least there is concern here, once again, for a second day in a row surrounding Palantir.
That's exactly what I was just pulling up. Dan Ives' Twitter account, or X, he said that the Palantir sell-off, it's just the bears poking holes yet again. He says it's similar to the DeepSeek sell-off, just some noise and not something to worry too much about. But of course, Palantir investors clearly not seeing that the stock is down 10%. So how realistic are all of the cuts the Trump administration is currently touting to spending? According to a new memo from Defense Secretary Pete Hegseth, his plans for the Defense Department aim to reduce projected U.S. military spending by 8% over the next 5 years, sparing certain areas within the defense space, though, including border control. Joining us now for more, we've got Henrietta Trey's, a managing partner and the director of economic policy at Veda Partners. Henrietta, great to have you back with us. How realistic is Hegseth's goal here to cut defense spending, and what do you think that could potentially look like?
Yeah, thanks for having me. I think it's completely disingenuous, frankly. To say that you're going to cut 8% is one thing, but be aware that in the Senate, we have a bill that is going to be voted on later on today, authorizing what will ultimately be $350 billion in additional defense spending spread across immigration and military spend. So they could maybe cut around the edges and identify some areas to trim back. But on the other hand, and simultaneously, the U.S. Senate is moving forward with a bill that would exponentially increase defense spending. In addition, there's another CR, a government funding bill, that needs to pass by March 14th, which also includes a 2.7% uptick in military spending versus 2025. So I think if you're going to base this on what's going on in DC, you need to look at Congress more than the White House.
So how do you see this netting out then?
I expect federal spending to rise throughout 2025 on almost every sector, defense and non-defense discretionary.
Can we talk about that in the context, too, of this idea from Musk? He teased out this idea of sending $5,000 checks to citizens following these cost-cutting measures, sort of like a dividend payment to the American public. How does that help DOJ with their goal to cut $1 to $2 trillion from the deficit?
It obviously doesn't. If you have $55 billion in savings, which is an inflated figure that their receipts do not prove, but let's just say it's accurate, providing stimulus checks to American voters is $1 trillion plus proposition. So the math does not add up. We do know that the president is very supportive of those individual stimulus checks because we saw them in his first term and he very much liked signing those. And it was a huge part of the reason he was so popular during that time. So would definitely expect this to be something that they talk about, but obviously it would blow a hole in the deficit.
Yeah, Henrietta, how would this plan even work in practice? Could it?
It wouldn't. I mean, they have to get something through Congress. And right now, as we can see through the warring internal debate between the House and the Senate Republican conferences, they have not yet identified a path forward just to keep taxes flat, let alone provide stimulus checks of, I think you said $5,000 per person. It's entirely unrealistic. The math there is honestly really hard to wrap your mind around. You're talking trillions of dollars. So they don't have that in their current plan. And to enact tax policy, you need to have Congress. Legislation has to originate in the Ways and Means Committee. You have to go through Congress for something like this.
Do you anticipate Senate Republicans fracturing even further from the president ahead of what the president called yesterday that one big, beautiful bill that he is hoping for that includes those $4.5 trillion tax cuts?
Yes, the Senate is prepared to move forward with something called Vote-A-Rama beginning tonight. It will last 50 hours, and it is a direct defiance of the president's stated preference for one big bill. This is a $342 billion measure that, again, spends hundreds of billions on military and immigration and opening up energy permitting. It does not need to be offset in the reconciliation instructions, and they are moving forward with those votes today in direct opposition to what President Trump tweeted about yesterday.
Henrietta, I'm curious, just given the uncertainty coming out of Washington and given the research that you've done, in terms of what this means for the business community, what have you seen as the impact there?
There's a lot of concern around the tariffs. I would say a tremendous amount of focus on whether the Canada-Mexico tariffs really go into effect on pharmaceuticals, on energy and automobiles. I'm expecting that those get excluded from any tariffs that go into effect on our USMCA allies. But tariffs on China, I think, are taken very seriously. And then the EU auto tariffs also need to be taken very seriously as well. And I think the street's getting to that view now.
Henry, do you think, I would actually ask if the market's still discounting that, though, just the real risk of it, given the fact that it has been able or has shrugged off some of those most recent developments?
Yeah, definitely. And I think that the president does such a good job messaging around tariffs. You float the idea in the Oval Office on January 20th, Inauguration Day, say that there's an effective date by front running your staff that's not even confirmed yet and say they're coming February 1st. And then now we slow walk that all the way through February into March 14th, into March 31st, then all of a sudden it's April. So investors are predictably and sort of justifiably not taking the president seriously. But a close, analyst, someone who follows former USTR Lighthizer, former USTR Catherine Tai, and incoming USTR Jameson Greer and Howard Lutnick should take these tariffs incredibly seriously. Not only do they absolutely have to have the revenue to offset the cost of this tax bill, but the president genuinely believes in the value of tariffs. And I think that there will be substantial tariffs imposed on or around April 1st, potentially with slow upticks, 5% to 10% to 15%, et cetera. But the tariffs are coming.
What do you tell clients about how that interplays with capital markets then? Because in the lead up to the election and a lot of our coverage, we were urging people to remember, and investors said on our shows, that you don't want to trade on policy, on a potential election outcome. Is it different with tariffs?
Yeah, I think it is. And I would discourage folks from looking at the idea of universal tariffs and taking the president literally on that one. I I'm not a big fan of that opinion, just because there are going to be exclusions. So I think the more nuanced investor would look at the tariffs and start to pinpoint individual sectors and start to say, okay, this specific company is going to be hit because we're going after X, Y, and Z. And that's going to be country and product specific. So for example, a Section 301 investigation into India that imposes tariffs as a result of, chemicals and pharmaceuticals, medical devices, that's entirely on the table. Are we going to see tariffs on Mexican automobiles? I don't think so. So you've really got to be very particular about how you play a tariff war.
All right, Henrietta, always great to talk to you. Thanks so much for making the time.
Thank you for having me.
Continue with the latest out of D.C. Doge claiming $55 billion in government savings so far. Elon Musk's Government Efficiency Commission uploading a list of everything that is cut from the federal budget to its website. Our very own Rick Newman has, of course, been combing through this, analyzing these records. What can you tell us? Where are we saving?
Well, the records that are there don't add up to $55 billion. And I'm not slagging the Doge Commission on that. I mean, they only started putting these records up this week. I guess it's good they're putting some records up, but for anybody who hasn't yet had the time to go through all these records yet on their own. So what they're doing is most of the savings that they're putting on this website are contracts at various federal agencies that they say they have either renegotiated or just canceled outright. So when I looked yesterday, I downloaded everything from the site. There were about 1,100 records there under contracts. There's another category called real estate. That's a lot smaller. There are far fewer entries there. So if you just add up all the savings they are claiming from everything they've posted on that site so far, it's about $8.5 billion, not $55 billion. So I can't prove that there aren't $55 billion in savings. Maybe there are, and they just haven't posted it yet. But there's this huge gap, and there are also some irregularities, like the New York Times found one example. I found some others where you look at the amount of savings they're claiming, and then you click on the document that they're directing you to, and the total contract value is less than the amount that they say they're saving. So they're not explaining any of this. That this is completely unaudited. So I have no idea if any of this is valid or legitimate. I'm just saying what they are showing on their website.
So we don't have the data to back up that $55 billion claim. The
Well,
data doesn't paint that picture.
So there's data for 8.5 billion of the 55 billion. So is the paperwork coming for the other, whatever the number is, 47 billion? I don't know. Maybe, maybe not. I mean, another oddity of this is they're not telling us a time frame. $55 billion this month, or it could, I think more likely, it's whatever the number is, it's over years, because when you renegotiate a contract, I mean, these contracts aren't just this month. These are 3-year contracts, 5-year contracts. So it seems like they are renegotiating payments that haven't even happened yet, and they could be counting that as savings. I mean, I don't want to just dismiss the whole effort. I mean, there is, without a doubt, there's bloat in the federal government, and they're going after it. But the method to the madness is not yet apparent. Put it that way.
Rick, there's also the legal side of it too, the challenges that are
Right.
also playing out for some of the cost-cutting measures and spending cuts that they do want to enact. So of course that also then begs the question about how realistic some of these plans even are.
Nobody knows. I mean, this is a gigantic experiment in how we run the country. So everything I was just talking about, all these things that are listed on the Doge website, none of that includes personnel. And we know from the headlines, they're trying to get rid of thousands, literally, probably hundreds of thousands of federal workers. There are, I think, 3 million. I think the federal workforce is about 3 million people, not including the military. And they so far seem to be going after a couple 100,000. Just to put this in context, I'm sure there's a lot of waste, fraud, and abuse here, but this is not where the big money is. The federal workforce, I think it's like 1.5% of total federal expenditures. All the big money is in Social Security, Medicare, Medicaid, veterans benefits, and defense spending. So the idea that, Henrietta, I loved Henrietta Treis's segment just before I came on, by the way. She's basically saying, you're seeing little savings over here, but they're massively inflating the deficit and the national debt over here, and she's dead right. So, I think they want the attention to be on the small savings they're getting over here because of the other part of the deficit is just ballooning.
And to your point, those Medicare cuts that are expected to come in the reconciliation bill, I doubt will be popular with voters.
Trump said this week he said he's not going to cut Medicare, Medicaid, or Social Security benefits.
Right.
Now they are going into they're clearly going into these programs and looking if they can cut overhead.
Right.
So the contracts show so far, I think they're claiming $200 million in savings at the Social Security Administration. So I don't, I get, what is that? Subscriptions to the Wall Street Journal and stuff like that. I mean, okay, fine. So they're not reading the news at the Social Security Administration. Voters obviously want to know their checks are going to keep arriving. And Trump obviously has to be careful that he doesn't interfere with the functioning of that part of the government.
All right, Rick, we got to leave it there. Thank you so much for
You don't want to do
us.
Doge all day?
It. We're going to do it in our show later.
Tease ahead. Capital gains.
Doge
We'll find out a lot more about it.
We will be talking about Doge and more later today. Rick, thank you as always. We'll have all your markets action ahead here on Yahoo Finance, so stay tuned. For all of Wall Street's optimism for a business-friendly environment under Trump 2.0, market conditions have proved much more difficult, especially for venture capital. Higher borrowing costs have put a stop to years of easy money, and fund managers are grappling with more cautious investors. Here to discuss further, Bradley Tusk, Tusk Venture Partners founder and CEO. Bradley, we want to get your take on the VC environment right now, given some of the pressure that we've seen from policy from the White House and also, of course, from the Federal Reserve. What are you seeing?
Look, VC has been effectively dead for the last 4 years. There's been no liquidity, both in terms of IPOs or M&A activity. And there was hope, especially in the fall, that would change for two reasons. One, the Fed was cutting interest rates, which makes sort of alternative assets more attractive. And two, the idea was with Trump coming in, you would have more kind of pro-business regulation, more pro-business regulators, and that combination. But I think instead what we've seen is A, the Fed is saying, look, we may be done cutting rates, and B, just the federal government is so chaotic that I think the markets don't really know what to do about all of it. And so instead of there being kind of a clear glide path for IPOs and for M&A, it's just chaos.
How much of a chilling effect then do you expect from that?
A lot. I mean, effectively, the chilling effect before was the result of the FTC kind of generally being so anti-M&A overall that it just sort of kept everything at bay. Right now, you might have better regulators from that perspective from the FTC, but when the operating system of governance is chaos at all times, that's not good for markets, right? And so I was hoping that we start seeing some real liquidity in Q1 or 2 of this year. And right now, I would be shocked if that happened.
Do you think we'll even see it in the second half of the year?
I don't know. I mean, maybe if Trump settles down a little bit, my kind of hope, and this is possibly totally naive given who he is, but came in with this massive ball of energy, all the stuff he wanted to do, and then kind of once sort of that clears out, things start to normalize a little bit. So I would like to see that happen for lots of reasons. But with that said, he is comfortable in one particular mode. And I think, for him, if anything ever does get too calm and quiet, he will come up with something to shake it up again.
How does that tie into what you think Elon Musk's end goal is? Because I've talked to some people this week who are concerned that all of the Doge cost cutting is in an effort to privatize some parts of the government that Musk can benefit from, and then others say that's a little bit conspiratorial. He's just trying to cut costs.
Yeah, I think if anything, you're being too generous. I think Elon's end goal is a lot like Trump's end goal, which is a lot like Kanye West's end goal, which is attention. The fact that we are talking about him right now is what he wants. And I'm sure they all prefer positive attention to negative attention, but they would vastly prefer negative attention to no attention at all. And so Elon is a really smart guy. He has done some tremendously impressive things like Tesla and SpaceX and Starlink. But I've also, keep in mind, I've been a tech investor for a long time, but I also worked in government for 15 years at every level of government. And A, he has no idea what he's talking about or what he's doing. And B, and I know people watching this show, because they're all private sector people, won't want to hear this, but running a government at a really high level, like I was the deputy governor of Illinois for 4 years, is exponentially harder than running a company. So many more stakeholders, so many more points of view, so many more inputs and variables that one of the real problems that you see all the time out of Silicon Valley is people don't know what they don't know. They think that just because they went to Stanford or they were a Y Combinator or they made all this money, they're a genius at everything. Like, no, you're a genius at raising tech funding startup, tech startup funding or engineering or whatever it might be. But the fact that you figure out how to get people their smoothies, a minute faster doesn't make you equipped to figure out what the budget should be for the U.S. Department of Defense.
So what does that then tell us just about how effective or ineffective he potentially is going to be then within this role?
Yeah, I mean, I think more ineffective than effective because, look, as the previous guest said, there's plenty of waste and bloat in federal government, and I think the notion that we couldn't make it smaller and more effective is great, but what he's doing seems to be so without regard to any thought that, there have been more plane accidents in the last couple of months than at any time in recent years, and I'm not directly blaming his cuts and pending cuts to the FAA, but clearly it's not the wrong time to have fewer air traffic controllers, right? And there are just so many different, cutting the DoD budget at a time where there's going to be a peacekeeping force needed of some kind in Ukraine, some kind in Gaza. The world is a volatile place. I thought Republicans were supposed to be for having a strong military, and instead it seems to be the opposite. So, if they were, like with tariffs, for example, there's at least some measure of thoughtfulness around it, right? Like what Trump has said is, we want to sort of study everything, see where the U.S. is being treated unfairly, where other countries are taking advantage of us, and then sort of act accordingly. That makes sense to me, right? Our companies shouldn't be treated unfairly. But with Elon, it's all move fast and break things. And look, when it's your private company with your money and your investors' money, and you want to do that, like that's kind of your business. But when it's 330 million Americans and their lives, that's another story. And that's before we get to the government shutdown in a couple of weeks.
Well, I want to switch gears a little bit and talk to you about DeepSeek before we let you go. How has the introduction of this AI that was seemingly trained for a lot less money than the AI players in the U.S., how has that changed how you are advising?
So it comes down to one question that we just don't know the answer to yet, which is, so DeepSeek says, look, we built this inference model because we had to, deal with the U.S. trade restrictions, and the inference model turns out is vastly better because it's at least 90% as effective with a fraction of the compute and energy cost. OpenAI says, no, you trained it on our model, which required all of that compute and energy cost. So ultimately, everything you're saying is totally false. If DeepSeek is right, overall for AI as a sector, that's really good, right? Because it reduces the costs meaningfully, and it means that for the ability of companies to use AI. A, they're not sort of hostage to a handful of companies like OpenAI or Anthropic or whoever else. And B, the costs that they'll have to spend to get it are a lot lower because people gravitate to the lowest cost technology that can do the job. Now look, there is a real fundamental problem that all of the US AI companies seem to fully believe that the only way to do AI was with hundreds of billions of dollars, if not trillions, in compute power and new energy sources. That's what Stargate was all about, and that might all turn out to not be true. And so what may be to the benefit of AI as a whole and consumers as a whole may be to the detriment of the major US AI companies because they may have thoroughly miscalculated.
Bradley, real quick, we only have about 30 seconds here,
Yeah.
but were you then a bit surprised, just given some of the rhetoric that we did hear from some of the larger cap big tech CEOs on their earnings call, kind of doubling down on that spending plans, on those spending plans?
You know, I think the problem is, one, there wasn't enough time for them to sort of pivot to a new reality. And so, you know, if investors on the earnings calls heard a lack of confidence, that would have shaken the share price. And I think to a certain extent, our CEOs are so overly held hostage by just what a handful of analysts sort of interpret on a call every quarter. But two, we don't know. So maybe Sam Altman is right. Maybe DeepSeek ultimately cheated all the way through. And you do need that level of compute and energy to do AI right now, in which case they're right.
All right, Bradley Tusk, always great having you.
Yeah, thank you for having me. I
To join us
appreciate it.
here. Coming up next, we're going to take a closer look at results from Alibaba. It's on pace for potentially its best day since 2022. We'll talk about some of those gains when we come back.
Shares of Alibaba continuing to climb after reporting a double-digit bump in its cloud segment revenue in the latest quarter. This comes after the company chairman confirmed it will partner with Apple and reports the company's weighing an investment in DeepSeek. Here with more, we got Santosh Rao, Manhattan Venture Partners head of research and an early investor in Alibaba. Santosh, great to have you on. I want to zero in not only on the cloud revenue rise of 13%, but that AI-related product revenue triple-digit growth for the sixth quarter. How is Alibaba becoming such a powerhouse AI play?
Yeah, absolutely. I think AI is going to help their core business. They're using it for their advertising, for their e-commerce, and all that. So I think it's a natural partnership there. So I think that's the key thing, and it's going to help every other company, Facebook and Amazon, to really enhance their product line, their productivity, their effectiveness. So AI is going to help across the board for many companies because of the way it is. So I'm not surprised. AI did help, but I think more than that, their core business did well. Their international sales did very well. Their global footprint helps. And their cloud business, of course, is a good anchor in their business. So I think that it's a good diversified company doing very well on the back of China recovering. The economy is just coming off their back, and the consumer is strengthening, but it's still weak. So there are a lot of issues out there, but I think they executed well. They had the Singles Day behind it also, so that helped also. So I think 4Q had some good favorable wins in their favor, and they are executing very well. So,
Santosh, how should investors be thinking about Alibaba? Is it simply now an AI company, just given the focus that we have certainly saw or heard on AI when it came to the earnings call and some of those lofty expectations in terms of that potential growth?
well, AI is a must. Every company has to use that word. That's like a compulsory, like we had the .com in the past. So AI, everybody's going to use the AI. But I think it's like Amazon. It's a company that will execute. It has a cloud business. It has an AI business. Now it's going to tie up with Apple. It has an e-commerce business and a search business. So it is really wide, has partnerships with many key players, and competitively, it's in a good position. And needs to keep innovating, which it is, because the competition is right nipping away at their heels. So they are executing well. That's the key thing. It's a big business. It's a big company, rather. So that's the key thing. AI is going to be in everyone's vocabulary, every company, every CFO's, every earnings call's vocabulary. AI is a must. And you'll see more and more applications come in there as we get deeper and deeper into AI. And as DeepSeek and other lower cost models come into play, I think the developers are going to find it easier and cheaper to get on, build on top of that. So that you're going to see more and more in 26, 27 when the applications take hold. So it's not surprised. It's going to help more and more, and Alibaba will be a big beneficiary.
Santosh, real quick, we have about 10 seconds. Are you a buyer then of Alibaba at these levels?
Absolutely. I would definitely buy it. It's coming off a very low base. Right. It has it's a huge company, huge market, and it'll continue to do well. I would definitely buy it.
All right, Santosh, thanks so much. Well, that does it for us today, but keep it right here. Wealth is coming up next. We'll see you tomorrow.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's time for Yahoo Finance's Market Minute. Stocks are lower as investors scrutinize earnings and weigh the impact of President Trump's trade agenda. Walmart shares are falling and on track for its worst day since November 2023 after the retailer warned of slowing profit growth in fiscal year 2026. Walmart's CFO saying of the conservative outlook, quote, "We have to acknowledge that we are in an uncertain time." And Chinese tech giant Alibaba set for its best day since November 2022 as investors consider its potential as an AI play. The company reporting a 13% rise in cloud revenue, CFO saying he expects growth to accelerate. And shares of the gaming platform Unity Software reversing course, now up double digits after initially falling this morning. The company beating analyst expectations in its latest quarter. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, you can scan the QR code below to track the best and worst performing stocks of the session. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Housing Hurdles will discuss why tariffs could have a major impact on home builders and the price that you'll ultimately pay for your home. And Inflation Nation. Walmart is out with earnings. We discuss how inflation has hit your wallet when it comes to your grocery bill and discretionary purchases. Plus, career hacks. We discuss how to pivot your career with purpose. I'll be joined by a career expert from LinkedIn. All that and much more coming up during today's show. But first, we take a look at some of the market action. We're 90 minutes into the trading day. Stocks are lower today. The S&P 500 pulling back from a new record high. Joining me now, we've got Keith Buchanan, who is Globalt Investment Senior Portfolio Manager. Now, you say the market is starting to pay less attention to rhetoric that we've been hearing from Washington. What does that mean and translate to through for investors?
Hi, Brad, and thanks again for having me. We just noticed how the reaction of the markets has started to diminish some when it comes to the big statements, and whether it's through social media or through some of the faces you see on the news shows and political back and forth. We just don't think the reaction is as vitriolic as we saw, over the past couple of weeks. And the market's starting to grasp what is happening. The proverbial sausage is being made, and getting its arms around an administration that had a totally different take on how to handle these situations as far as the public-facing statements. And there's a bit of adjustment that had to happen, but we don't see the reactions of the previous couple of weeks continuing as the back and forth about trade continues to progress with us in China, the North American back and forth that we're seeing as well. So we're moving past that. The market feels like it's starting to get more of a grasp on the cadence of this trade rhetoric, and we think that coming forward in the next couple of weeks, that will continue to diminish.
Do you think that cadence, even as the markets are trying to best anticipate what that cadence looks like from here, that there's still the potential for a volatile reaction here from what we've seen in some of the tariff announcements or even the broader economic impacts of immigration policy?
Absolutely. There's always potential for a negative reaction. We feel like the rhetoric is starting to, the reaction from the rhetoric is starting to diminish, but when the policy starts to take shape, that will still, of course, move markets one way or another. But we're seeing the market start to decide between the rhetoric evolving and what's turning into policy. And the former will cause intraday moves. The latter, of course, will dictate where we go the next couple of years and be a little more impactful to market direction. But just the day-to-day rhetoric is being looked at as being perhaps not how the policy will end up, and that's critical, we think, over the next couple of weeks as the market starts to get its footing behind earnings.
And so, Keith, while we have you here and we're talking about earnings, we got, of course, the best barometer for retail, perhaps, at least in the U.S., with Walmart reporting here today, and them having a clear line of sight into how consumers are still purchasing everything from groceries to some of the discretionary spending. What are you seeing as a pull through, perhaps one of the denominators about the consumer through an earnings report like that?
That's a great question. Walmart is a holding we have, and we look at this name as a stalwart of not only where the consumer stands, but also inflation and as a hedge in an interesting way. As they've picked up more customers that they define, the more affluent customers, those making an income of over $100,000, that traffic has continued to improve, as we saw started to happen when inflation really reared its head a couple of years ago. Walmart is also in the process of monetizing traffic through its app. Also really pushing forward on the delivery experience, whether delivery at home or to the car, where that also gets captured within an e-commerce business, which is still growing at a clip that is impressive. What happened to Walmart, in our opinion, is the valuation was well north of the market because of that execution they have displayed over the past couple of years. And the stock has been rewarded for it. And the sell side and buy side assumptions had moved north of where reality of the company had grown. So the anticipation and frankly optimism about the company had probably moved a little further than the story had developed. And we're still comfortable with the execution of the management team. Highlighted inflation being perhaps a limiting factor this quarter in the grocery space, and that's not necessarily anything that we didn't feel like was warranted. So, Walmart, in our opinion, is still a company that executes at a very high level. Again, gives us a read-through to the consumer, but also picks up flow of traffic of customers, frankly, that haven't shopped at Walmart in perhaps a decade or so. So we're really excited about the story. The valuation, again, is rich, and today offers an opportunity perhaps to get more involved.
It sounds like it's still one of the top picks for you and the team here. Another one of them is Delta. Take us into your thinking there.
Sure. Delta's riding a wave of travel experience that we saw pick up in a very material way right after the pandemic really started to wane, and really had to slow down. And we've seen flocks of people coming through TSA turnstiles, and we have data on this on a daily basis. We're running well north of the best travel of the year, which was 2019. At the same time, we've seen fewer worldwide carriers. Now it used to be 7 or 8, 15 years ago. Now it's 4 big global carriers that now can have a little more discipline as far as what routes are or have how much capacity, and have a lot more sustainability to fares that we've seen have inflated over the course of the last 4 or 5 years. Delta specifically still has the business travel component. It's actually shaped itself into being more of a luxury carrier. The business component is still coming back, but we've seen pay down of debt, now they're investment grade quality debt, and the cash flow they're generating right now really bodes well for the continued traffic we see coming through air travel here in the U.S. and internationally, and also the capacity to be able to keep prices sustainable and actually moving higher to capture more of that marketplace. So we're really excited about the opportunities that Delta shares offer our clients as well.
Keith, thanks so much for taking the time here with us today. Appreciate it.
Absolutely. Thank you.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got Catalyst co-host Madison Mills. Maddie, first up, we got to talk a little bit about Airbus this morning. Trading lower after guidance disappointed investors. The plane manufacturer missing on estimates for adjusted EBIT and free cash flow for 2025. Its plane delivery target falling just shy of expectations, 820 planes versus the 823 planes that were expected here. Shares right now down by about 2.5%.
Yeah, a couple of interesting things here. Of course, the production challenge is something that was very key for investors heading into the call, and that did become clear. Them flagging that short-term production pressure and confirming a delay to its A350 freighter, as it did predict a 7% increase in deliveries to around 820 jets this year. But they are going to continue to clean up some of the trouble that they are seeing in their space and defense projects. That was not enough to give investor optimism, though, given that delay in the A350 aircraft there. Interesting commentary, though, from the CEO, talking specifically about competition from a Chinese aircraft manufacturer. He said on the record that he could see the duopoly between Airbus and Boeing becoming a triopoly between Airbus, Boeing, and this Chinese company Comac that has really sort of developed their own version of the Boeing 737 that has gotten a lot of attention, specifically amid all of the headwinds that Boeing is facing with safety of that aircraft in particular. So I think that the CEO of Airbus kind of fueling that question mark was a really interesting decision there, perhaps one that he thinks will position them better as sort of news that would negatively impact their competitor, Boeing, as well. But interesting to see him adding to that idea that Comac could be a real competitor here.
Yeah, that's a major acknowledgement, especially given that these two companies, Airbus and Boeing, have really been able to account for 90%, a little over 90% of the large plane manufacturing orders that the market has seen here. So we'll continue to track Airbus shares today. Let's get a little more tasty with it, though. Shake Shack is rising after fourth quarter earnings result. It was a mixed quarter for the company. Baird analyst David Tarantino saying that the company and the commentary implies a better than feared start to the year. Shares right now, they're up by about 10%, perhaps on some relief here, at least in line with what the analyst was saying.
A lot to like under the hood of this report, but in particular, there was concern that the company had raised with investors that the wildfires were going to be a significant headwind for them, and then their Jan comp sales, just for the month of January, comp sales were up 3.7% year over year, so that's what that Baird analyst is referring to there, this idea that the print was better than feared. But there's, again, a lot to like outside of that. Raymond James talking about how the company has impressive labor leverage, given that their fourth quarter store margins rose by 22.7%, specifically talking about how they've been able to leverage their labor costs really effectively. Again, William Blair talking about a resilient trend for the month of January. Also, I think it's interesting that they talk about how long-term this is one of the strongest and most proven growth runways among emerging restaurant brands. So that is significant for a company like Shake Shack that has a lot of competition in the space from the likes of Sweetgreen, Kava, all of these other recent IPOs in the space, but clearly seeing a positive lift to Shake Shack here, which again is also, I might add, lastly here, significant given some of the pressure that we've seen in the other retailers amid consumer weakness, the likes of Walmart being the latest among them. Seeing Shake Shack be able to kind of buck that trend of consumers buckling under the weight of inflation is really impressive.
All right, 13% sales growth system-wide there. Not too shabby at all for Shake Shack in the most recent quarter here. Maddie, thanks so much. My stomach's growling already.
Yep. Thanks, Fred. Appreciate it.
The majority of 401k and state-sponsored IRA plans offer target date funds, or index funds that shift from risky to more conservative investments as you get closer to your retirement date. But you don't have to rely on someone else's plan to make that happen. Yahoo Finance's Carrie Hannon set up her own target date retirement fund, and you can too. Carrie, walk us through some of the steps that you took.
Hey, Brad, thanks a bunch. Yeah, I'm not exactly a do-it-yourselfer, but when it comes to my retirement investments, I like to have a little more hands-on than just set and forget, right? So I decided I was going to create a custom target date fund for myself. And so what I did is I picked the date that I thought would be the year, ostensibly you would retire. So maybe it's 2035, 2045, whatever it is. And then I looked at the various mutual fund companies and other financial services. T. Rowe Price does this, Vanguard, Fidelity, on down the line. And I looked at what their target date fund in the year that I selected as when would be my retirement date. I looked what their funds had and what the holdings. Number two was, so I picked the date and I did my research of who had a date fund in that year. The second thing is I checked the holdings. What does that target date fund hold? Which index funds? And generally they are index funds. Do they have an international fund, a total stock market, a bond fund, international bond fund? Number three is look for low expenses. I looked through the different fund companies. Fees are across the board. These are typically fairly low fee investment. So you want to go there. The fourth thing I did was, I picked who I was going to go with. And in my case, it was Vanguard. I already had an account there, so it was pretty easy. I opened up my IRA there, my individual retirement account there, and I added the funds. I looked at exactly what their fund had in that target date. I added those precise funds into my own account, but I tweaked it a little bit because whereas they had a certain percentage in equities and a certain percentage in bonds, I wanted a little more equity exposure. I was a little bit more of a risk taker than they had aligned for me. So I tweaked it just a bit, but I used that as my guidepost, right? So, I'm not going to go flying down into the gutter with my bowling ball here. I use that as my guardrails. And the last thing that I do is every so often, and certainly once a year, I go back and I rebalance it. I tweak it to get it exactly to make sure the asset allocation is right for my risk tolerance and my time before I think I'm going to need those funds. And so it's very important to sort of look at it, rebalance it, because now you're in control. There's not a fund manager who's going to be a target fund manager who's going to be doing that for you. And the truth is, Brad, I actually ended up with a lower cost fee because the target date fund as a whole was more expensive than the individual index funds that I put into my account. But I'm not paying for someone to manage it, right? I'm taking that responsibility. But I got to tell you, it's loads of fun, and it keeps me paying attention to my investments. Maybe not everyone wants to do that, but it makes me feel in control.
Carrie, thanks so much for breaking this down for us. Appreciate it.
Thanks, Brad.
Coming up, the impact tariffs could have on home builders and even the price that you pay for your house. We break it down with Jim Tobin, who is the National Association of Home Builders CEO. You see him there. Stay tuned. Frigid temperatures and tariff woes across the U.S. are taking a toll on the housing market, according to a slew of data this week. Housing starts fell sharply during January, while permits inched up slightly, though a decline on the year-over-year basis. Home builder confidence for February also dropped to a 5-month low as builders remain cautious about the future. Joining me now, we've got Jim Tobin, who is the National Association of Home Builders CEO. Jim, good to have you back on the program. Just want to get your read through the state of the housing market as you see it.
Well, I think right now it's stuck is the way I see it. Between I know I'm reading this week with a drop in 5 points on the HMI. Not surprising given what you said, the tariff woes, immigration, of course, the pace of the new administration and uncertainty around the market. Plus, we're also looking at a stubbornly high mortgage rates hovering near or close to 7%. The existing market continues to be locked up, and I think builders are starting to wonder how soon we're going to see this recovery we've been hoping about.
And so what would be the key to that recovery? Is it actually just lower mortgage rates from here, or is it more supply actually entering into the equation?
The only way we're going to build ourselves out, or the only way we're going to get out of the housing affordability crisis we have across the country, is to build more houses and apartments. And so that's a combination of things that are going to allow us to do that. Number one, we need the regulatory environment to get better for us. We're hoping that President Trump will do that from his perch at the top of the government pyramid. But we're facing headwinds with potential tariffs. We already have tariffs on Chinese goods coming in. There's the hovering threat of tariffs on Mexico and Canada, our two best trading partners. In fact, the president last night announced potentially another 25% tariff on Canadian lumber. We get 30% of our lumber from Canada, and that will certainly crimp our ability to build more houses, but build those houses affordably.
So that seems like, at least from what we're talking about here, and hoping that we were going to see help coming from President Trump on the housing front, it seems like a double whammy, though, is actually happening here, both on the supply side and building out some of these homes because of the potential for these tariffs to be enacted. And the question remains of how long they would be on the table. But then also on the employment side, as you're seeing even more of a crackdown on immigration and some of the workers that would potentially help build out some of these homes.
Yeah, it's definitely mixed signals here in the first month of the administration. The president signed an executive order on day one that was trying to direct his government to help build more housing and build more housing affordably and drive prices down. But yet the immigration enforcement actions we're seeing are having a chilling effect on the construction workforce. The threat of tariffs, again, potentially layering on more costs, whether it's on appliances or whether it's on lumber and building materials. That's really running counter to that executive order in our mind. Again, we have not seen the regulatory rollback we have, but it is early days, and we expect those to come over the next months. But we do have these mixed signals, and you see that in our HMI reading, where the builders are, when they're looking forward, it's not as rosy a picture as they thought just a few months ago. So still a long way to go, but there are some headwinds in front of us.
With that in mind for the builders, I mean, one of the popular things that they've implored is doing the mortgage rate buy downs. Do you see that being something that is not going away anytime soon?
It depends. The larger builders are going to have a better capacity to do that. In our reading this month, we saw that incentives are actually falling out there. I think that's just more the lack of traffic than it really is whether those incentives are working. But smaller builders that build the bulk of the housing in this country, they may not be able to offer those deeper discounts on rate buy downs. It's still a valuable tool, especially as you're trying to get mortgage rates down from the high 6s into the magical 5s. But it's going to take a little bit of time and a little bit of work for buyers to come off the sideline and feel that they're the biggest investment they're going to make in their lives, that they've got a good runway to be able to pay that mortgage and afford that home.
I want to try and squeeze in 2 more quick questions while we've got you, Jim. Number one, how is affordability impacting the regions that you're seeing as hotspots right now?
Well, if we have to build more houses anywhere, of course, the hot spots are the southeast and the southwest of the country, kind of the Sun Belt. We continue to see people want to move down there, whether it's for the lower regulatory environment. Lower home prices are really driving a lot of that in-migration from across the country. But again, we're seeing these pressures starting to put on those markets like Dallas or Houston or the Miami markets and Orlando markets. So it's everything is starting to impact. Again, tariffs and immigration policy are really starting to squeeze every market in this country.
Well, also a consideration for 2 of those markets that you mentioned in Houston and then additionally in areas like Miami, Florida, is, of course, climate. how is insurability in some of these climate areas that have been more prone to potential billion-dollar disasters as measured by NOAA impacting the purchase propensity that we are seeing right now because of the insurability?
People still want to live on the coast, or they want to live next to rivers. They still want to live where they want to live. And insurance is going to be the next big affordability crisis we're facing. We're already facing it. In some instances for multifamily properties, I've heard 200% or 300% increases in their annual premiums. Again, that's going to get passed along to renters. Same thing with home buyers. If they can't afford the insurance product on a home, they're going to look other places. So I do think that the insurance crisis in this country is going to start moving people to those lower risk markets, perhaps in the Midwest, where you don't have these the threats of these natural disasters. But insurance is something we're watching very, very carefully. We've got to get our hand on it. Again, it's going to be the biggest driver of affordability in the next few years.
Jim, always a pleasure to grab some time with you and get your perspective. Thanks so much. Coming up next, we're diving into the state of the consumer with Walmart earnings. Those shares are under pressure. But fear not, investors. I spoke earlier with TD Cowen senior analyst Oliver Chen, and he says it's still a long-term play in his book.
It's not a cheap stock, 38 times PE. You can't forget that. We have a buy rating. We like it for the long term, and we like this whole flywheel between technology meets value meets grocery leadership.
Weak guidance for the full year is weighing on shares of Walmart this morning. With more on what the retailer's earnings tell us about the state of the U.S. consumer, I'm joined by Yahoo Finance's Brooke DePalma. Brooke, you actually had the chance to speak to Walmart CFO John David Rainey this morning. What did he tell you?
Yeah, John David Rainey kicked off the phone call with Yahoo Finance this morning, really trying to alleviate any fears among investors that there's something between the lines here, some sort of concern about the economy or business. He told Yahoo Finance rather that he feels really good about the state of the business right now. And he described the state of the U.S. consumer as steady and consistent. He said specifically that we can see that their wallets are still stretched, so they're far from what we might call back to normal. Consumers are buying more private brand items. They're spending more on food versus general merchandise as they have historically in recent years. Now, he echoed what we've also seen in recent inflationary reports like the Consumer Price Index, that eggs continue to drive inflation. He said that that is driving up the overall portfolio. And in a distant second, other items that are still inflationary include bacon, sugar, canned soda, as well as that ground beef. Now, consumers are also returning to general merchandise. We saw that this quarter for the second time in a row, and that's driven by what he said was a better assortment of products as well as a growth of its online marketplace. Now, some items that they're seeing deflationary within the general merchandise category includes headphones, TVs, sporting goods, as well as pet food. But keep in mind, should potential tariffs go into effect, that could offset. He told Yahoo Finance that Walmart is not immune to the potential impact of these tariffs, but they typically will work with suppliers on this. He said we'll shift supply where we need to. We can lean into our private brands. There's a lot of tools that we have to try to keep those prices lower for consumers. Now, one source that I did speak with this morning said specifically that Walmart has this bit of a leg up here, that they're very good about working with their vendors and their suppliers to keep those prices low. So should those tariffs go into effect, well, they might have a leg up against competition here to once again keep prices low. That could then drive in even more consumers than they've seen in recent years. We know higher income consumers are going them for value and convenience.
Yeah, absolutely. They got great golf shorts too. Brooke, thanks so much. Appreciate it. Shares of toy maker Hasbro rising after topping analyst expectations in its latest quarterly report. It did, however, in its 2025 revenue forecast come in below expectations as Hasbro included the impact of tariffs on imports from China and potential levies on Mexico and Canada. For more on this, I'm sending it on over to our very own Brian Sozzi, who has Hasbro CEO Chris Cox on deck. Soz?
All right, thanks so much, Brad. Yeah, Chris, always great to get some time with you here. Stock ripping, one of the hottest tickers on the Yahoo Finance platform. Some of the folks I talked to this morning, Chris, saying they've given you high remarks for cutting costs. Like, how much in costs have you cut out of this business the past 2 years, and how much more is left?
Gosh, I think we're over $600 million of costs taken out of the business. Probably about 2/3 of that is via our supply chain, and then the balance is from just general overhead and admin savings.
Can you get to, what else do you have to do to get to that 1 billion mark? I think you put that out today as part of your longer-term plan.
Yeah, we still have some general admin and overhead that we can save. So that's what we pay for vendors. That's kind of like the overall kind of overhead associated with the company. Supply chain will be a big contributor for us as well. We're doing a lot for design to value to take costs out of our products, but still maintain really good quality. And then there's this whole thing that's called gross to net, which is basically the difference between our gross revenue and our net revenue. And that has to do with how much discounting allowances we put into place and other kind of trade allowances that we put into place, generally to account for overbuilding a product. So the better we get at forecasting and the better we get with supply chain management, the less we'll have to put in there. And, you know, when you look at supply chain, gross to net, and kind of like our general kind of like overall spending, that really kind of forms the lion's share of how we get to $1 billion of cost savings by 2027, which was the revised target we just talked about today.
Chris, I'm inspired by everything in your background. I think those are all toys that I would purchase maybe at some point soon, but I do realize I'm not the norm. Why are toy sales in the US still under pressure? What's going on here?
Well, Brian, I actually would say you're increasingly becoming the norm.
It's because I'm getting old, right?
Yeah. The fastest growing segment in both video games as well as toys are people over the age of 13. You know, the biggest segment now in video games is actually consumers 35 plus. So high-end collectibles, things from your childhood, that's a big, powerful motivator for the toy industry, has been for the last couple of years, and I think will be for several more. Unfortunately, Hasbro has its better than its fair share of volume from that. 60% of our sales are from 13 plus. Now, there is a little bit of pressure in some other areas of the toy category. A lot of that just has to do with the toy volumes normalizing after the pandemic. You know, the toy category has been down kind of like low single digits per year for the last 3 years. We see that starting to flatten out and basically being flat for the next 2 to 3 years. We think Hasbro will benefit. We've got a great innovation portfolio coming out. We have strength in that quote unquote kid-old segment. And we have a very diversified business. It's not just toys, it's also licensing, which is a business that's up 60% for us over the last 2 years, as well as games with some huge franchises like Monopoly and Magic the Gathering.
Chris, how much of a headache are tariffs to a business like Hasbro?
Well, it's certainly one that we'd like to minimize. You know, the toy industry in general thrives on sub $10 and sub $20 price points. A company like Hasbro has been working very hard to take costs out of our mix and push more value into the channel. And, like when you think about the typical American family, probably 95% of American families have a Hasbro product inside of their toy chest or inside of their game chest at the home. Our hope is that we're able to get through this phase of tariff negotiations, find a good conclusion that allows us to keep prices low and bring smiles to kids' faces at price points that are as low as possible.
Is the reality, though, Chris, that this coming holiday season will simply be more expensive?
I think a lot depends on how the whole tariff scenario plays out. When we look at like the current kind of like guidance that we've given, which factors in the 10% on Chinese tariffs, pricing will be a variable that we play with, but I think it will be very targeted. So, in general, our focus is to bring more value and more products at sub $10 and sub $20.
Can you manufacture toys profitably in the United States?
We do. So a lot of our Magic the Gathering business, which is by far our biggest brand, it's over $1 billion and drives a heck of a lot of our bottom line health. It's made in North Carolina and Texas. We manufacture board games in Massachusetts. So certainly we can do it. I think the challenge with manufacturing a lot of toys like action figures and kind of like higher turnover toys is it tends to be, those toys tend to be very manual to create. And they also tend to have a fair amount of turnover because like about 50, 60% of SKUs in the toy industry change each year. It's a fast fashion category. So I think bringing back manufacturing jobs to the US would require us to do very heavy automation, and it would be a pretty heavy lift and take multiple years.
Fair point. Lastly, Chris, too, it's not lost to me that you have another partnership with rival Mattel. I remember you announced something similar with some other brands more than a year ago. Is the reality that given the cost environment, tariffs, cost of labor, you name it, that your two companies are going to have to work together?
Well, I think the reality for Hasbro is we already work with Mattel, we already work with Lego, we work with Spin Master, we work with all of the major toy manufacturers. And I think that's an advantage we have. We see partnerships as an opportunity to extend our brands, to bring more value to new consumers, and to make some money in the process. As I said, our licensing business is up 60%, and that's a very high margin business for us. So I see that as a power trend moving forward and something that's just net goodness, whether it's Play-Doh plus Barbie, like we just announced today, Transformers and Hot Wheels, D&D plus Lego, or supersized board games like we do with Spin Master.
No chance in hell I'll be able to make one of those Play-Doh Barbies. I'm just going to say it there. I wanted to get that out publicly. Chris, looking forward to seeing you around the Toy Fair. Chris Cox, Hasbro CEO. Good to see you.
Thanks so much.
All right, Brad, back over to you. Out of everything, I can still smell Play-Doh, Brad. It's like one of those smells you just don't forget.
Yeah, you don't forget it at all. You'd like to pretty quickly, but perhaps it brings back some of those childhood memories, Saz, for sure.
Or nightmares.
Oh my gosh. Well, depends upon what you were doing with the Play-Doh, I suppose. We can take that offline. Saz, thanks so much for that interview. Appreciate it. A programming note, on this week's episode of Stocks in Translation, Jared Blickery and Sydney Freed sit down with Peter Borish, who is the Computer Trading Corporation CEO, to discuss tariffs and a strong dollar.
If you're going to put tariffs on, how do you fight that? Well, guess what? You depreciate your own home currency. That then offsets partially the impact of tariffs because the dollar gets stronger. So there's this tug of war, and when things get out there, and I know this is a shock to a lot of people, but people in this administration, they tend to have ego. So if it's not working, they're going to go more. And they're going to go until something breaks, and that'll probably be a second derivative speed of the dollar.
You can watch Stocks in Translation every Tuesday and Thursday at 8:30 a.m. Eastern on Yahoo Finance or wherever you get your podcasts. Coming up, the state of the labor market. We have tips to help you pivot careers with purpose. That's next on Well. Let's get a check here on the markets as we are 2 hours into today's trading activity. We're taking a look at the Dow Jones Industrial Average. It's actually down right now by about 1.4%. Let's pull up the chart on this one just so you could see some of the slippage that we've been tracking intraday. Of course, that is a longer term view there for the Dow. And this is what's happening here now, as Luther Vandross would say. We are down by about 1.4% as mentioned. The Nasdaq Composite, that too is down by about 0.9% on the day. And the S&P 500, which just yesterday did see some new record highs as well, that is down by about 0.9%. So retracing just a little bit from those levels, but still in the general ballpark, or at least in the parking lot of the ballpark. As of right now, we're also taking a look at some of the moves within the sector activity on the day. Let me jog on over to that and put this on an intraday here. Somebody's been active within the Wi-Fi Interactive here today. Financials, you're seeing that lower by about 2.1% during today's session. It's been continuing to slip here during today's activity on the front half of today's trading session. But take a look at XLV. That's finding some gains, finding some love here for healthcare. That's up by about 0.3%. And lastly, here's just a brief look at the Nasdaq 100 as we ride out with a quick look at that heat map here. Also, everyone, switching gears. This Black History Month, we celebrate the power brokers in business, the executives, the entrepreneurs, and proven change makers who have advanced the economy and society. Sean Tresvant took the helm as Taco Bell CEO on January 1st, 2024, making history as the first Black American to lead the company. He joined Taco Bell in 2022 as their Global Chief Brand Officer and later expanded his role to Global Chief Brand and Strategy Officer, leading to his promotion to CEO. He carries a wealth of experience from his 15-year career at Nike, including serving as the Chief Marketing Officer for the iconic Jordan brand, and is currently on the board of Marriott. Under his leadership, Taco Bell has been dubbed one of the twin growth engines by Yum Brand CEO David Gibbs. Tresvant provided 3 leadership lessons to Yahoo Finance, and here they are. Number 1, You don't have to have a black belt in everything. Leadership isn't about being the best at everything. It's about recognizing that you can't do it all. And number 2 here, it's hard to make a Crunchwrap, but keep at it. My first attempt at the elusive Crunchwrap fold during his restaurant training was far from perfect, but with time, practice, and the courage to ask, got better. The same is true for any skill in business or in life. Growth doesn't happen overnight, and success isn't instant. And third, from Trezvant, service with a sonrisa, smile. Leadership isn't all about standing on the sidelines. It's about showing up, setting the tone, and leading by example. When you bring your best self, your team feels it and follows suit. Sometimes it's the smallest gestures, even a smile, that makes the biggest impact. The number of Americans filing new applications for unemployment benefits rising slightly last week to 219,000 from a revised figure of 214,000. That increase is still consistent with a healthy labor market, but Wall Street is watching for any signs of cooling as the Fed continues to battle sticky inflation. Here with more on the jobs market is Andrew McCaskill, career expert at LinkedIn. Andrew, great to have you back with us on the program. Let me just get your read of the labor market right now from what you're seeing.
Listen, I think the numbers aren't going down that much, right? So we're still in a strong labor market, but a strong labor market can be a double-edged sword. I mean, with steady hiring, employers may not feel the need to add, new perks or to raise wages. But keep in mind, these numbers do not include the more than 200,000 federal workers who had their roles eliminated. And the question on many people's minds is whether or not the private sector will be able to absorb this influx of federal workers who are rejoining the labor market. It's already competitive. And now there's another 200,000+ folks who may be in the market.
And so with that in mind, for those who are trying to, and we're going to come back to the government side of this in a hot second here, because that's very important. But as you're thinking about the role types that are still continuing to be in demand right now, even in the conundrum and the mechanics that are, the machinations that are taking place within the jobs market right now, where are those roles still in high demand?
Listen, I think we see a lot of opportunity for folks in hospitality, and we see a lot of hiring that's happening in healthcare, a lot of hiring that's happening in education. We'll come back to those sectors a little bit later when we talk about government employees. But I think that where people have to do is they have to think about if you're not getting those roles right now, or if you've been in the market for a while, pivoting is essential, right? You've got to look and say, now the time is to pivot. Opportunities still exist. Sectors like retail and healthcare continue to show really strong job openings, and you got to make those moves really strategic. If you're breaking into a new industry, and it requires professionals to really be clear and connect their existing skills to those new roles. And the bottom line is the job market may be tighter, but there's so many professionals who pivot with a purpose can still land new opportunities.
And so you have 3 tips for pivoting with purpose. What are they?
Listen, number one, you've got to own your transferable skills. Skills like leadership and problem solving, creativity and strategy, those things are always a big ticket to get into other industries, right? Like right now, it's February, it's Black History Month. We talk to Black professionals in particular, and the tip number 2 about seeking out community and mentorship, 65% of Black professionals said that networking and mentorship has driven their career growth, right? And that's really interesting because about 64% of them say that they're looking to change jobs this year. You got to do things like upskill and staying sharp. If you're interviewing and you're not getting those roles and you get all the way up to the interview part and you don't get hired, interviewing might be one of those skills that you need to bone up on. Also, identify gaps and level up. If you're seeing job opportunities out there and you're looking at those job descriptions and you don't meet every single criteria in this economy, you've got to say, how do I fill in that gap? How do I take a course or upskill so that I can fill that gap in? And technology is your friend on this. And I would say that even if I didn't work at LinkedIn.
Certainly. Andrew, while we have you here, let's talk about a little bit more what you were mentioning at the top here. We are seeing many reports of layoffs and buyouts across various government agencies as the Elon Musk-led Doge looks to cut costs. Can you provide some tips for those workers who might be out of the job and looking at new roles?
Listen, I think smart pivots for these folks means chasing growth. Government workers have incredible skills around policy and communication and management and regulatory expertise, but they need to package them the right way. Number one, you got to flip your resume like a pro. Frame your expertise in policy or crisis management or compliance in terms that the private sector actually understands. So translate that government speak into private sector impact. Instead of things like stakeholder engagement, think about it as a corporate partnerships work, right? Or constituent services. You may need to talk about consumer engagement. The language here really matters. Take a look at job descriptions that are in the private sector and say, okay, this is what correlates to that. So flip that resume like a pro and your LinkedIn profile. The other thing I would say is be really strategic and then follow the growth. According to LinkedIn data, the top industries that government workers have historically pivoted to, there are 4 of them: professional services, education, manufacturing, and hospitals and healthcare. Now that you know where people have historically gone, now you go where the growth is. Healthcare and education are hiring above pre-pandemic levels. Now, on the flip of that, you've got to say professional services and manufacturing, they're still catching up. But if you're thinking about who typically hires people from government, and then which of those sectors are actually hiring right now, you're ahead of the game. And then finally, you got to activate your network, man. I know I talk about networking a lot, but government careers are built on relationships anyway. And so if you've been engaging with private sector companies in partnerships and things like that, reach out to those folks that you worked with previously. Right now, it's February, it's Black History Month, and we're doing a series called The Power to Pivot, where we talk to Black leaders about major pivots in their careers and their career journeys. And one of the folks that we talked to was a lifelong public servant, worked on the Hill, and used a relationship and a conversation that he had with someone that he'd worked with and pivoted his role into a corporate job in their policy division, right? And so that's just the way it works. Those relationships are going to help you out.
Andrew, we got to leave things there. Thanks so much for taking the time today. Appreciate it. Coming up, everyone, if you're one of the 86% of Americans who had financial goals for 2025, listen up. We're breaking down the top ways to improve your saving habits. That's on the other side of this break. A whopping 86% of Americans surveyed by Bank of America had a financial resolution going into 2025. 71% said that they expected inflation and cost of living to impact their spending. Joining us now with some tips for all of this and much more, we've got Mary Hines-Drosch, who is the Bank of America Head of Product for Consumer, Business, and Wealth Management, Banking and Lending. Mary, great to have you here. As an expert, we got to know, what are your top 3 budgeting tips?
Well, thanks, Brad, for having me. As you can see, 86% of the consumers we surveyed really are looking to have better financial health, but it's really hard to stick to it. You start January, you have your resolutions. I'm going to save more. I'm going to pay down my credit card debt so I can take big trips. But what happens is those resolutions don't really result in anything. So we recommend set specific goals and really stick to them and be intentional about how you spend. One of the tips that I personally use is a do not spend list. I have a lot of everyday luxuries. For example, I get a latte on my way to work. Its price has increased 30% over the last couple of years. So in the month of January, I would not let myself purchase that Monday through Thursday, and I would treat myself on Friday. Those are small things that really add up to big savings. Another thing that's just the reality of the world today, it's so easy to spend money. It used to be you could freeze your credit cards as a way to constrain your spending, but now your credit card is embedded into digital wallets on your phone, within apps. You click a button and you're spending money. So one of the things I've done with rideshare apps, which is another one of my temptations, instead of taking the subway, I take a rideshare, is I deleted the app. So I no longer can click that button and keep that spending under control.
And so while we have you, what are 3 things Americans are prioritizing in their budgets right now from what you're seeing, and 3 things that they can start to deprioritize perhaps this year?
Yeah, well, as you mentioned, 71% feel the impacts of inflation really impacting their ability to keep good financial health. And so groceries continue to be a priority because that's really what's gotten more expensive. Things like eggs have over doubled in price over the last couple of years. Also, wellness. People are really focused on health and wanting to do right in order to feel good and live long, healthy lives. And so that things like yoga studios and exercise bikes continue to be important. And then finally, travel. 40% of people said that that was a big priority for them, and that's up from 32% last year. So we continue to see life experiences being the priority for our consumers.
Mary, thanks so much for taking the time here with us today. Some really interesting findings and insights, and hopefully I'll do a little bit better on my own budgeting this year too. Thanks.
At your do not spend list.
Exactly. Everyone, that is it for Wealth. I'm Brad Smith. Thanks so much for watching. You can stay tuned for Market Domination coming up at 3 p.m. Eastern Time. You don't want to miss it.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack. Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's time for Yahoo Finance's Market Minute. Stocks under pressure as Walmart's conservative outlook triggers worries over the resilience of the consumer. The Dow now off just about 1.5%. Palantir, the top trending ticker on Yahoo Finance, sinking for a second day in a row. You're now looking at losses today of just about 9%. This comes following the CEO Alex Karp's new stock sale plan. Also commentary from Defense Secretary Pete Hegseth on budget cuts. Carvana having its worst day since August of 2023 amid concerns about declining profit per vehicle. The company's revenue per vehicle falling by $1,000 to just over $22,000. And bank stocks are under pressure today. Goldman suffering its biggest loss in about 6 months, and JP Morgan is also in the red amid a shift in investor sentiment. Financials are the worst performing sectors so far today. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of this session.